Very good morning, friends. So I hope you're all doing well. And I've always been saying that, and we're almost on the last leg of financial instruments. And I believe you're doing a cumulative revision of all the concepts we have covered so far. So our journey has been pretty long on financial instruments, but we still got some special issues of discussion. If you remember last session, we started off our discussions on one of the four special issues with you. And I said the four special issues is one is dealing with the concept of derecognition. Second, dealing with the concept of impairment. Third, dealing with the concept of hedging. And number four, dealing with the concept of derivatives which are embedded in the instruments, and that's called embedded derivative. Well, we started our discussions on the concept of derecognition of financial instruments when we are dividing our discussions in two parts. One is we are focusing in terms of derecognition of financial assets, and the other one is we're looking at derecognition of financial liabilities. So we'll go one by one. We have already, laid down the broader principles, or I would say a three-step model, which outlines the parameters, or you can say the principles, which governs the derecognition of financial asset. Under the Ind AS, companies cannot simply remove. Derecognition stands for removal. They cannot remove the financial asset from the books of accounts just like that. There are certain principles, there are certain parameters which needs to be met. And I had given you a simple three-step model. I'm just going to take a quick recap on the three-step model which I gave you. And today we're going to dig deep into the concept of those three tests and also the three kinds of accounting which I identified. So let's, I think, first make a quick mind map and then we'll start working on this. So we started our discussions on derecognition of financial assets. So I'm making a quick mind map on the three steps which I gave you on the concept of derecognition of financial assets. So when we say derecognition, what should immediately come to your mind is removal. So derecognition basically means a removal of financial asset from the books of accounts. Now, we decided that we're going to apply step number one, ABC in a sequence. Step number two, two possibilities, rather three possibility. And the step number three, again, two possibilities. So you need to first map your mind that in terms of the step number one, the focus is on what we call cash flow test. The focus is on what we call the cash flow test. So step one is supposed to be a cash flow test. And to remind you, this is to be applied in terms of a sequence. So we're going to apply this in terms of a sequence. Your thought process has to be based on a sequence. And what was the sequence in terms of ABC? The sequence is when you go to the step number 1A, you need to see is the cash flow expired. We yet to see what does expiry mean. And if you say a yes, in this particular case, you are supposed to derecognize the financial asset. But if you say no, then it is time to go to the step number 1B. It is to be applied in a sequence. So your mind should be clear. Step number 1A is met, derecognition. No further principles, parameters to be applied. If you say the cash flows expired, the end, derecognition. If you say no, you go to step number 1B and you say, is the cash flows transferred? You need to see that is the cash flow transferred. When you say yes, it is transferred, you need to go to the step number 2. You're going to take decisions at this stage. You need to go to the step number 2, which is conducting a risk and a reward test. And if you say no, then in that case, we go to the step number 1C. And once you say the step number 1B, you said a no, you go to 1C, and it is a case to identify, is it a case of PTA, pass-through arrangement? We're here to discuss all these technical terms. What do you mean by expiry? What do you mean by transferred? What do you mean by PTA? That is a pass-through arrangement, just terms at the moment. So when you say, yes, it is being transferred, you need to go to the step number 2. And if you say no, then in that particular case, you continue. You continue with the financial assets in the books of accounts. Derecognition cannot occur. The financial assets would continue. So the failure of step 1A takes you to B. The failure of 1B takes you to C. But the failure of 1C would mean that the financial asset cannot be derecognized. It is going to be continued in the books of accounts. Then we came to the next agenda, and that is the step number 2. And the step number 2 is regarding risk and reward test. It is supposed to be risk and the reward test. So our second step is in terms of evaluating the risk and the reward test in this case. So we evaluate the risk and the reward test. In terms of the risk and reward test, we said there are possibilities, not a sequence. In step number 2 and 3, remember there are possibilities, not a sequence. So we're going to look at the various possibilities which can arise. And there will be again a total of 3 possibilities which will arise in this particular case. The possibility number 1 is that the risk and reward is substantially transferred or it is substantially retained. The word is very clear. It is substantially transferred or it is substantially retained. We have to analyze what do you mean by substantially transferred? What do you mean by substantially retained? So all these parameters are yet to be understood. This is just terms coming at the back of your mind. And it could be neither of the two. That means neither substantially transferred nor substantially retained. Now, if you say it is substantially transferred, then in that particular case, it is derecognized. If you say that it is substantially retained, it is continued. And if you say it's neither, then we go to the step number 3. So at the first instance, you need to be very clear in terms of which step passes or fails, what is the course of action. You need to be clear in step 1, there are sequences in 1A, B, C. In terms of step number 2 and 3, there are possibilities and not sequence. Either it stands substantially transferred, derecognized, substantially retained, continue. And the failure of the step 2 takes you to the step number 3, and that is the control test. So let's have a look in terms of the step number 3. And the step number 3 in this particular case leads to what we call the control test. Now, what is the control test? We're yet to see all that. But in terms of step number 3 as well, you are going to look at possibilities. You're going to look at possibilities again. They are not sequenced, but we're looking at the possibilities which could arise. And there are only 2 possibilities in terms of step 3. Either the control is transferred or the control is retained. The concept of substantial does not exist here. So there are only 2 possibilities. Either it stands transferred or it stands, you can say, retained. So if you say it is transferred, then it is supposed to be a case of derecognition. But if it is supposed to be retained, then it is a case of partial derecognition, not a case of continue, not a case of continue. So I think what you need to identify is that based on all these permutations and combinations, one thing comes out very clear. There are 3 kinds of accounting. You can see it's a case of derecognition or a case of continuing. It's a case of derecognition or a case of continuing. So in terms of step 1 or step 2, either you reach a conclusion that it is derecognized or it is continued. But the moment you reach the step number 3, then it becomes a case of partial derecognition. So I think what you need to also understand as an implication is that there are 3 kinds of accounting. What you need to understand is there are 3 kinds of accounting. depending upon the parameters of which test passes or fails. Though we'll come to the clarity later again, I don't want to, create combinations at this stage. You know the sequence, but we'll come to the deeper combinations later. But there are three kinds of accounting, and the three accounting is either it is 100% derecognition, or it is a case of that you continue the financial asset in the books of accounts, or it is a case of a partial derecognition. But one thing I can clearly say that once you reach a step number 3, only then a case of a partial derecognition can take place. If you're in step 1 or step 2, you don't go to the step number 3. It's either a case of a full derecognition or a case of continuation. Step 1 and step 2 would result in these kind of accountings. It is only when you reach a step number 3, then it results in a different accounting, and that is called a partial derecognition. So at the first instance, your flow should be very clear that, okay, which combination leads to what kind of accounting. For example, if I say that the cash flows are expired, I immediately shoot out, yes, it is a complete derecognition. If I say, okay, the cash flows are transferred and the risk and reward test is also substantially transferred, derecognition. If I say that there is a cash flow transferred and the risk and reward is substantially retained, I would say, okay, this is a case of continuation. If the risk and reward is, if I say the cash flows are transferred, the risk and reward is neither substantially transferred nor substantially retained, you go to the control test and the control test is retained, partial derecognition. Now, the only thing which we need to understand clearly, which we're going to do today, as we proceed with certain illustrations, we're going to see which combination, how do you conclude which accounting applies. That's one. So we have to see in an analytical manner, looking at the case study, looking at the illustration, that, okay, once I read the language of the question, I can reach a conclusion that this is the combination happening, that this is the kind of accounting. So identifying the kind of accounting is one issue which we need to understand. And the second is how that typical accounting is applied. So we've got two major agendas of discussion now. So one is that once you look at the facts of the case, you are able to zero down that, okay, in this case, this is the kind of accounting. You reach a conclusion that, okay, this is the kind of accounting, and then how this accounting is done. So it's going to be a little technical to begin with. I know what we are speaking today early in the morning is going to be a bit technical, but it's very interesting. Once you get the grip of the case, trust me, you're going to enjoy the concept of derecognition. That was mind mapping, just to quickly recap and connect all the dots in terms of which combinations apply. So far, so good. Now what we're going to do, we are going to work upon the technical terminology. So I'm going to first of all introduce you what is the concept of expiry, what is the concept of trustword, and what is the concept of PTA. So we're going to understand these three terms so that the cash flow test becomes absolutely clear. Then we're going to go to the concept of understanding what is the concept of risk and reward. How do you reach a conclusion that it is substantially transferred, retained, or neither? And then we're going to go to the control test. So we're going to work on each and every test, terminology one by one, before we go further. So I think let's begin. I'm just retain the chart. I'll come back to the chart maybe later. So first, I think what I want to explain is the inputs which are given in the study material regarding the concept of expiry. So I guess I am just going to zoom this across. Maybe it might not be too much visible. It's perfectly okay. So don't get worried on that. I know it may not be visible too much indeed, but that's perfectly okay. I just want to read a line to you. So just bear with that. So there is an input which is given in the study material in the point number 3. We are looking at unit number 5 now. So unit number 1, 2, 3 has been what we are discussing. Now we're in unit number 5. It says the cash flows from a financial asset expire upon payment of entire due amount, or The legal release of the debtor by the creditor from the obligation to pay. Okay, so let's understand in simple words what is expiry. Well, I'll put it in simple words. When you say the cash flows are expired, I call this in simple words FNF. What is FNF? Full and final settlement. So you need to put across a question. For example, I have a debtor in my balance sheet. I sat down with the debtor and I said, okay, let's sit down and let's do an FNF, full and final settlement. Then I would say the cash flows are expired. In simple words, what I need to prove? In simple words, I need to prove that from today onwards, I am not legally entitled to receive anything further from my debtor. Mind the words. I should be able to prove that, from today onwards, since we have sat down for an FNF, I am not legally entitled to receive any further payments with him. There is no further payments. There is no future payments he's going to make to me because we've done a complete, full and final settlement. So that's what it says. It says upon the payment of the entire due amount. So he pays me whatever is due, 100% collection done. That's one. Or the legal release of the debtor by the creditor. So either I waive off the money. So there are two cases when I would say it is expired. I sat down with him. He paid the entire due to me. That's full and final. The second is I said, okay, I waive off the money. Now from today onwards, you don't need to pay me money. So if I release him as a creditor, because I am his creditor, so I am his creditor because he is my debtor, I am his creditor. So when it says legal release of the debtor by the creditor, it says from the obligation to pay. So either you legally release the other party from making any further payments, or you sit down and do a full and final settlement. You receive the entire amount due. That is a case of expiry. Now, let me also caution you, friends. A sale of the asset is not a case of expiry. A sale of the asset is transferring the cash flows to some other party. Because when you sell an asset, in that case, the cash flows will now be received by the other party. So somebody approaches you and he buys a financial asset from you, then you are transferring the cash flows which will arise from the financial asset to the other party. So it is not a case of expiry. So do not confuse the word expiry and the word transferred. When we say transferred, it means that you have transferred the cash flow out of the asset. So instead of me receiving anything in the future, the other party is going to receive the amount. So that is called cash flow transferred. Don't worry, we'll document all those things later. So let me also take you to the concept of what is meant in terms of cash flow transferred. So this may also not be visible too much, but I think I'm just wanting to show you a little inputs. Maybe this might be a little more visible. If not, that's perfectly okay. No worry, we'll document all this part. It says the examples of transfer of the right to receive cash flows includes sale of a financial asset. It says example, investment in a debenture or assignment of a receivable like factoring arrangements with banks or financial institutions. I would say when you say that the cash flows are transferred, I would rather consider three examples of cash flow being transferred. I would say when you say the cash flows are transferred, the sale of a financial asset is cash flow transferred. The bill receivable getting discounted is a case of cash flow transferred. The assigning of the trade receivable to a factoring agency is the cash flow transferred because you are passing on the right to receive the money to another party. It's not that the creditor, it's not that your debtor is not going to make any future payments. He will not make future payments to me, but he's going to make a future payment to another party to whom you sold the asset. So remember, when I say sale of the asset, it's not expiry, it is transferred. When I say discounting the bill of exchange, I would say it is transferred. When I say it is assigning a trade receivable, it is supposed to be cash flow transferred. I hope, friends, I stand clear on expiry and I stand clear on the concept of what is trustworthy. We need to be very clear on the concept, what is expiry and what is cash flow trustworthy. So when I quickly put the words to you, full and final settlement, I've received the entire amount. I've received the entire amount. It's a case of expiry. I waived off my liability, or I waived off the liability as a creditor. I told my debtor, no need to pay any further amounts, expired. When I say it is trustworthy, sale of the asset, discounting the bill of exchange, assigning the trade receivables to a factoring agency, the whole case of trustworthy. So far, so good. I guess pretty clear. That's great. Now, I think let's go ahead and we're going to go to the next input, that is PTA. Okay, now in terms of PTA, we need to explain something. So let's I think for the time being, document these two parts and then come to the concept of PTA, pass-through arrangement, which is a very typical kind of arrangement. So I think first of all, let's pen this down. So I'm just going to pen this down and let's first of all add the inputs at this stage. So I'm putting the inputs regarding the step number one. I'm putting the inputs regarding the step number one, which is called the cash flow test. So this is called the cash flow test. So we can say when we're looking at the cash flow test, my mind is working on three inputs. So one is on the concept of expired. One is the concept of trustworthy. So we've got expired, that is one. We've got trustworthy, that is two. And we're given PTA, that's called pass-through arrangements. It is called pass-through arrangements. In short, it is called PTA. That's called pass-through arrangements. Okay, so what we need to keep in mind is when you say the cash flows are expired, this means two things. Number one, entire amount received. When I say entire amount received, I'll put it in the brackets as full and final. It's called a full and final settlement done. The second example could be when you say expired, it would be in terms of that you waive off the future payments. You tell the other person there is no need to make any future payments, and that is also indirectly F and F. So you can say when you sit down and do a full and final settlement, either you receive the entire amount or you waive off any future payments. It is a case of expiry. When you look at the case of transfer, I would say this would mean three, any of these three. One is a sale of financial asset. The second one would be a case of discounting the bill of exchange, of course, a bill receivable. When you discount the bill from the bankers, then in that case, you transfer them the cash flow. They are going to receive the cash flows thereafter. Or it could be a case of assigning. It could be a case of assigning the trade receivables to factoring agency. So to the factoring agency, so that is a case where the cash flow gets transferred. So I think expiry is done, transfer is done. Now comes the case of PTA, that is a pass-through arrangement. Now this we are going to see there are a total of three conditions. I'll explain this with a diagrammatic view. So we'll understand that there are three conditions which are there on PTA, and trust me, all conditions are required to be met. All conditions are required to be met. Any one of the condition fails, it is not a case of PTA. Any one of the conditions will fail, it's not a case of PTA. So there are going to be three conditions which are required to be met before we can call it as a PTA. Okay, so now let me take you on those three conditions as far as a PTA, a pass-through arrangement, is concerned. Now, let's come back on the study material, and we are given some inputs regarding the concept of a PTA. I'll explain that with a simple example to you. So coming back on the study material, and let's have a look out here. Let me just zoom it further. I'll need the theory below as well. So there is an illustration number 6. There is an illustration number 6. I hope, friends, that is visible. Good enough to you? Is that visible, I guess? I need the portions below as well. I hope it's good to go. Yes, great. Now let's have a look at the illustration 6, which says it is a PTA, pass-through arrangement. It is called a PTA. Now let's first understand what is the concept of PTA with a very simple example to begin with. And then we'll come back to this illustration. But I think first we need to understand the example. Let's, I think, visualize something. Now watch this carefully. This is slightly technical, but I'll first make a visualization to you. Let's understand the concept of a PTA with a simple diagrammatic position. So let's see the inputs in this case. Let's say there is a company A Limited, and let's say there is a trust in between, and let's say there is some unrelated investors. There is unrelated investors. Now watch this carefully. We'll go back to the example and we'll connect the dots in that case as well. Now, A Limited is in need of money. Please mind the words carefully and please hear the story very carefully. A Limited is in need of money, and therefore what it does, one way is it could traditionally approach a bank and take a loan, but it doesn't want to do that. So what it does, it basically creates a trust. Now what is going to happen in this case? It creates a trust, and once A Limited creates a trust, so he tells the trust that you do one thing, you issue securities. You issue securities in this case. Find out some unrelated investors who are not related to my company. Find out all those unrelated investors. So basically what the trust does, it basically tries to issue securities to unrelated investors and take money. Now, why would anybody give money to the trust? Because they will not trust the trust. You're getting the point? They will not trust the trust. So they will say that these people will say that why do we buy these securities from you? You are issuing the securities, but what is your standing? Why do we buy these securities from you? So the trust tells these unrelated investors that, against the security, there is a pool of financial assets created by A Limited. The trust tells those unrelated investors that there is a company A Limited which has pooled its financial assets, and they will pass on the cash flows. They will pass the cash flows to me, and I will pass it on to you without any delay. I will pass on to you without any delay. So the trust tells these unrelated investors that against these securities, the returns which you're going to get is basically arising out of this pool of financial assets, because the back-end arrangement is when the trust will issue the securities, they will give the money to the trust in terms of buying this security, and he will pass on this money. He will pass on this money to the company A Limited. And look at the diagrammatic view. A Limited is approaching a trust and tells them that to issue securities to unrelated investors. The money which comes from the unrelated investors is passed on to A Limited, and A Limited gets an immediate liquidity. And A Limited gets an immediate liquidity. A is not wanting to go for a traditional loan, and it wants to go in for an arrangement where it creates a trust in between. I'll not get into all those technicalities that why A would do all these things, because this has been all a part of the larger plannings of companies, and therefore these standard setters had to bring out and plug those loopholes. because companies were doing these kind of arrangements and derecognizing their financial assets. So they said, we don't stop you in terms of doing these kind of arrangements, but at the same instance, I will allow A Limited to derecognize the financial assets only if certain parameters are met. Because companies were trying to find out ways and means of organizing liquidity, getting the money arranged, and at the same time, derecognizing financial assets from the books. Because that's going to be a good advantage. Because if I traditionally take a loan, it appears as a liability in the balance sheet. It disturbs my debt equity ratio. And I don't want to do that. I don't want to disturb my debt equity ratio. So what do I plan in this case is try to make some complex kind of arrangements where I can bypass and try to derecognize. So the standard setter said, no worry, we've seen that this is what is happening in the practical life. And therefore they said, no worry, you can definitely do this arrangement. You want money, you created a trust and you took the money from investors, and this money is passed on to A to get immediate liquidity. It's fine. And then A Limited, what it is doing, all this financial assets pooled, the cash flows coming in will go to the unrelated investors. So instead of making a direct sale with the investors, you're putting, in between a trust, and you're trying to just, create a chain of things. That doesn't make a difference. So they call this entire inputs as a PTA, a pass-through arrangement, because he will pass the cash flows to the trust and they will pass on without any delay to the unrelated investor. So the standard setter said, let's evaluate certain conditions. We'll give you 3 conditions in this case. If those 3 conditions are met, it will be called as a pass-through arrangement, and you will be able to meet the first step and apply the risk and reward test. So let's now see what are the conditions which are attached to this. So we're going to look at the 3 conditions now. So when you say it is a PTA, when you say it is a pass-through arrangement, just keep the chain in mind. A passes on the cash flows to the trust, trust passes on the cash flows to the unrelated investors. Now, what's this? It says all of the following conditions need to be met in such situations for a transaction to qualify as a transfer. Now, there are 3 conditions, as I said. Condition number 1, condition number 2, and condition number 3. Let's see what are the conditions. It says entity has got no obligation to pay the amounts to the eventual recipients unless it collects equivalent amounts from the original asset. When I say the entity, in my example, it is A Limited, who are the eventual recipients, those unrelated investors. So it says the entity, that is A Limited, has no obligation to pay amounts to the eventual recipients unless it collects equivalent amount from the original asset. So I pass on what I receive. In simple words, the condition 1 is I pass on what I receive. If I receive X rupees from the original asset, I pass it on through the trust to the eventual recipients. As an entity, I'm not liable to pass anything other than what I do not receive. I am not obliged to pass on anything other than what I don't receive. If I receive the money from the original asset, I pass it on. If I don't receive anything from the original asset, I've got no obligations to make any further payments. So the cash flows are restricted. The passing on the cash flow is restricted only to the extent what comes from the original asset. Next, this will indirectly mean no further obligations. Then he says the entity is prohibited by the terms of the contract from selling the asset or pledging the original asset, and that's other than a security to the eventual recipients. As entity A, he cannot sell the asset further. He cannot pledge the financial asset further. Once he decides to enter into such an arrangement, A Limited will lose any rights to either sell the financial asset or even to pledge it as a security to obtain any further money. And then it says, the entity has an obligation to remit any cash flows it collects on behalf of the eventual recipients without any material delay. So let's put this in simple words, that what are the 3 conditions? If I just go back and see what are the 3 conditions. A will pass on what he receives. That's one. A will pass on without any material delay. So he passes on whatever he collects. He passes on without any delay, and A does not have the right to pledge or sell the financial asset. If you're able to fulfill the three conditions, if you're able to prove that A Limited has got no right to sell or pledge, one, A will pass on only what he collects from the original asset, not even a penny extra. Two, and number three, you can say that he passes on the things without material delay. Now, what is a material delay is nowhere defined in the standard. But I think it's like as soon as possible without any kind of delays. So you pass on as you receive, you pass on what you receive. Mind the words, you pass on as and when you receive, and you pass on whatever you receive without any further obligations, and you cannot sell, you cannot remit. It is as good as a transfer. It is as good as a transfer, and that's called a PTA. I hope, friends, you got the connect of the three conditions in this case. I know what we are speaking is quite technical indeed. So you said, so here the entity is the trust or A. I think I answered that A is the entity out here. The entity is A and the trust is somebody in between. The unrelated investors are the eventual recipients in this case. Now, let's, I think, come back on the illustration number 6. Now, with this inputs in hand, let's read the data in terms of illustration 8. Keep that chain in mind. A, trust, and unrelated investors. And we're going to see in this case, what is this? It is in the form of dividends. Yes, you can say that. Now, let's have a read. It says entity A. Entity A makes a 5-year interest-bearing loan that is called the original asset, 100 crores, to entity B. The original transaction is between entity A and B. So A gives a loan to entity B, A creates a loan receivable, B creates a loan payable to the extent of 100 crores in the books of accounts. So this is the original asset, the loan which A gives to B. A settles a trust, creates a trust, and transfers the loan to that trust. The trust issues participatory notes to an investor entity C. You can see the chain that the transaction is between A and B. So A creates a trust and then he says, I will pass on the cash flows to unrelated investors to whom the trust has issued these securities, and that entitles the investor to the cash flows from the asset. So the chain is clear. A passes on the cash flows to the trust. The trust will pass on the cash flows to the eventual recipients, that is entity C in this case. C pays the money to the trust and the trust passes on the money to A Limited. So A Limited gets a liquidity by B Limited sitting as, intermediary in between. Then he says, as per the trust agreement with entity C, in exchange for a cash payment of 90 crores, the trust will pass to entity C 90% of all the principal and the interest payments. So against 100 crores, the money which is being transferred is 90 crores. So the trust passes on 90 crores to A. A says, I will give you 90% of the principal, 90% of all the interest in this case. Collected from entity B as and when and if collected, as and when. As and when means without any material delay. If collected means I've got no obligations to pay any extra money. Two conditions met. When it says in the bracket as and when, and if collected, I would say two conditions gets met at this stage. You're saying that I will pass it on without any material delay. You're saying that I will pass on only what I collect from the original asset, not even a penny extra. And then he says the trust accepts no obligations to make any entity to C other than 90% of exactly what is received. That makes the third condition met. So the trust says that I've got no obligations to make any other payments other than 90% of what is received from the entity B. So what we collect, we give you only that. The trust provides no guarantee to the entity C about the performance of the loan and has got no rights to retain 90% of the cash collected from B, nor any obligations to pay cash to C if the cash is not received from entity B. He makes it very clear, I've got no obligations to give you any extra money. I pass on what I collect and I give you nothing extra. I don't give you any guarantees and all. So is that also indirectly passing on the risk and reward? Maybe yes. So compute the amount to be recognized if the three conditions are met. And I think if you look at the language of the question, the three conditions in this case is met. You're passing on the cash flows without any material delay. You're passing on whatever is collected without any extra obligations or any guarantees, and you cannot sell or pledge as well. So it says the proportion sold is derecognized provided the entity transferred substantially all the risk and reward. So that is the test number, that is the test in the step number 2. Because this will pass on the cash flow test, but if the risk and reward is also transferred, this entity A would report a loan asset of 10 crores and derecognize 90 crores. So I think in this particular case, since you have transferred 90% of the cash flows, we will derecognize 90% of the loan. 10 crores was never transferred, so 10 crores remains as it is. We'll also come to a concept what is called part of the financial asset getting derecognized. So there may be a case of a full asset getting derecognized or a case of part of the asset getting derecognized. In this case, since 90% cash flows are being transferred, it's a case of derecognizing a part of the asset. Don't call it as a partial derecognition. No, no, no. Please don't confuse this as a case of a partial derecognition. It's a derecognition of a part of the asset. It's not partial. It's a part of the asset. Since you're transferring 90%, so A would report, continue to show the loan at 10%, that is 10 crores, and derecognize only 90 crores. Let's just connect the dots once again. So when you're looking at a case of a PTA, a pass-through arrangement, you would say that there are three conditions which needs to be met. A Limited as an entity has to pass on all the cash flows to the eventual recipients without any material delay. It has got no obligations except the cash flows which it receives from, you can say, the original asset. And number 3, it has got no right to either sell or pledge that original asset. If these conditions are met, it is a case of PTA. Then you go to the risk and reward test. If the risk and reward test is met, that means it is substantially transferred. Derecognition of the financial asset can take place. So in this particular case, the company will be able to derecognize 90% of the loan, that is 90 crores, and the remaining 10% continues in the books. I hope, friends, you're able to connect the dots. Okay, I think some inputs coming in. Let me see if any questions there. So 10 crores will remain in the books of A Limited. Is that right? Absolutely. A would continue to show this in the books. Okay, and you said, sir, which books ABC where the pool is created? Okay, let me just, connect the dots once again. We are focusing the accounting in the books of A. We are, I'll also tell you something without getting into technical detail. Remember in CA Intermediate, you did the concept of securitization, debt securitization in financial management, where you said the pool of financial assets are put together and it leads to the concept of a debt securitization. This is exactly what is happening in this case. That A Limited is going to, first of all, pool the financial assets put together and create a pool of financial assets and then transfer the cash flows arising out of that pool and try to organize a debt. And that's what you did in financial management, called the concept of debt securitization. So this is exactly what is happening in terms of the books of A. So all what we are discussing is from the point of view of the books of A. We are not doing the accounting for the trust. We're not doing the accounting for the eventual recipients, that is the unrelated investors. The focus is when A enters into an arrangement with the trust, what kind of entries is he going to pass in this case? If he is able to fulfill the 3 conditions which I gave you, If he's able to fulfill, the risk and reward is substantially transferred. A will be able to put the entry bank account debit with the amount collected 90 crores. Financial asset gets a credit to the extent of 90 crores and the 10 crores continues in the books of A. Right? I hope I stand absolutely clear on my thoughts. Okay, so I think it's time to pen this down as well. So I think let's go back on the first chart which I'd given you. And I think let's put this across as well. So I think I just need to now add those three conditions. Clear? Wonderful. So let's pen this down. What are the three conditions of PTA? So we're looking at the concept of a pass-through arrangement and we've got those three conditions. So let's pen down what are those three conditions. So we can say the condition number one, entity has to pass on, entity has to pass on all the cash flows, has to pass on all the cash flows without any material delay. Without any material delay. Now, what is a material delay is nowhere defined in the standard, but this has to be applied with some common sense that when we say it is passed on without any material delay. So you need to pass on the cash flows without any delay, any material delay as soon as. Then there is a second condition, and the second condition is entity has to pass only those cash flows which are received from original asset, which are received from the original asset. So he will pass on only those cash flows which are received from the original asset. So only those cash flows will be transferred which are received from the original asset. In other words, we can say, there is no further obligation. There is no further obligation. So there is no further obligation nor any guarantee. There is no further obligation nor any further guarantee. So he does not stand any guarantee. And of course, when I say the word entity out here, these things are effectively done by the trust on behalf of the entity, but we're still using the word entity in this case. So this is the second condition. And then the third condition is the entity cannot pledge. The entity cannot sell or pledge. The entity cannot sell or pledge the original asset. So they will not be in a position to sell or pledge the original asset in this case. So neither they can sell nor they can pledge the original asset. So let me also add the word out here. So we can say without any material delay to eventual recipients. To the eventual recipients. Okay, so I think that takes care of the three conditions. Entity will pass on the cash flows without delay. It has to pass on only those what are collected from the original asset, and he cannot pledge the original asset. So all these three conditions need to be met. Any one condition fails, it is not a PTA. So let's, I think, make a mention. All are required to be met in this case. So I think I'll just add on out here. Any condition fails. Any condition fails, it is not PTA. It is not a PTA. So once any condition fails, it's not a pass-through arrangement. Okay, so I think we're done with the step number one. Now, very clear. Just to quickly connect the dots, why I'm spending good time on this, because once we read the questions and we look at the parameters, we need to be crystal clear in terms of, okay, this is how we decide that the cash flow test is passing, failing, the risk and reward is passing, failing. We're going to see all that. So my step number one is now done. So when I look at the word expired, it basically comes to my mind full and final. You've already collected the entire amount or you've waived off the other person to pay. When I say it is trustworthy, it is sale, it is discounting the bill of exchange, it is assigning a trade receivable. When I say PTA, there are three kinds of conditions which are required to be met. All conditions met, you go to step two. Any condition fails, it's not a PTA. The asset will continue in the books of accounts. So far, so good, friends. I hope I am clear with the cash flow test to you. You should be clear on the terms expiry, on the concept trustworthy, and on the concept of three conditions in PTA. Now we can go to the step number two, risk and reward test. Okay, that's great. Now let's, I think, go to the next agenda, that is risk and reward. Now, this is interesting. Now, this is going to involve a bit of financial management as well. We're going to explain the concept of risk and reward, and there are a lot of inputs which are given in the standard and also discussed in the study material regarding the concept of risk and reward. So please start hearing this carefully. This now becomes interesting. So let's have a look at this. I'm looking at the point number 6 in the study material, unit number 5. Let's illustrate the risk and reward test with certain examples, and we are given examples where the risk and reward is substantially transferred, and we are given examples when the risk and reward is substantially retained. So we're given a couple of examples where the risk and reward is substantially transferred and where it is substantially retained. Now, I need to give you some technicalities which I'll explain with examples, and you need to understand this very carefully. I'm going to mix financial reporting and financial management. Can I safely assume you know the concept of options, call options, put options, and then the concept of in money, out of money, deeply in money, deeply out of money, at money? Can I safely assume that? So can I go with the presumption that you know the concept of options, call options, put options, the positions being in, at, out, deeply in, deeply out? Can I safely assume that? Okay, I think I got some inputs. Yes, I can assume that. That's great indeed. So let's go with the assumption and let's read. We're looking at the examples when the risk and reward is substantially transferred. It says an unconditional sale of the financial asset. A made a sale of asset to B, no ifs and buts. It is called unconditional sale. I'll assume the risk and reward is transferred to B substantially. Simple. It says a sale of a financial asset with an option to repurchase the financial asset at a fair value at the time of repurchase. It's called a sale and repurchase agreement. A made a sale to B. A made a sale to B and told him that I will buy this asset at the fair value of the asset later. I'll buy the asset at a fair value later. Now tell me one thing. If I make a sale to you today and I am going to buy the asset from you at a fair value which prevails in the market, is there any incentive that I'm going to repurchase the asset from you? If I am supposed to buy the asset at the price which is the fair value on the date of repurchase, do you think I've got any incentives that I'm going to repurchase from you? Why would I repurchase from you? I can repurchase and buy that asset from anybody else in life. So I think the condition that I will repurchase at a fair value does not give me any kind of incentives in life that I will repurchase. So even if you enter into a sale with the option to repurchase at a fair value which prevails at the time of repurchase, I am not interested to buy. I have got no incentive to buy. Okay, let's look at the other one now. It says a sale of a financial asset with a put or a call option. Put or a call option that is deeply out of the money. That is, an option is so far out of the money, it is unlikely to happen. Now, let me explain this bit. Explain this bit. I think this is important to understand. So let's say this is A Limited and let's say this is B Limited. And let's take a transaction to understand this. Now, this is going to be a little technical, so watch this carefully. I'll take some figures to explain this position to you. A made a sale of the asset. Let's say for 2 lakhs. And A also does one thing. A also enters into a long call. When I say a long call, the long call means that A has got the right to buy. Because when I say long, A takes a long position means A paid a premium to B Limited and gets the right to buy it at a later date. So when I say it's a long call for A would mean that he's got the right to buy. And let's say this is a long call, and the long call, we decide an exercise price. I decide an exercise price. So let's say he decided that the exercise price is going to be, let's say, 2.2 lakhs. Now watch this carefully. You need to give me some answers. So A sold an asset for 2 lakhs to B today and tells him that after a period of 3 months, he says that after a period of 3 months, I am going to buy this at an exercise price of 2.2 lakhs. Now let's say we are trying to visualize the expected market price. I'll give you some permutations and combinations. The expected market price is, let's say, 2.6 lakh. The expected price is 2.2 lakhs. The expected price is 1.8 lakhs. And let's say the expected price is, let's say, to the extent of 1.2 lakhs, or the expected price is, let's say, 4 lakh. Now, please watch this carefully, because once you're able to understand this, we'll go back to the sentence. So A Limited tells B Limited, I am selling an asset to you today at a total of 2 lakh rupees. And he says, I am taking an option where it's a right for me to buy 3 months later at 2.2 lakhs. He says, after 3 months, I have the right. If I want, I will buy the asset at 2.2 lakhs. Now tell me one thing. If the price goes to 2.6, is A interested to buy? Say yes or no. If the price in the market is expected to be more than 2.2, do you think A will exercise the right in this particular case? So we can say it is supposed to be what? In money, at money, or out of money. And you said no. Why no? Can I say if I am able to buy at 2.2, then I can sell it in the market at 2.6 and pocket the difference of 40,000 rupee. So I would be interested to buy. Let me, I think, remind you, in terms of call options, when do you exercise? When the market is bearish or the market is bullish? Think about this and decide, when are you going to buy in this particular case? Can I say when the market is bearish or when the market is bullish in nature? And I think you will definitely say, yes, it is supposed to be bullish in nature. Isn't that bullish in nature? The prices are going up. So I will say, yes, I will exercise. So we can say it is called in money. It is in money. Now let me ask you, does in money means that I am undoubtedly saying that I will buy, or I'm saying it's likely I will buy? I'll say it is likely I will buy. If it is in money, it is not an assurance that I will definitely buy. I'm saying that yes, it is highly likely, it's quite likely that yes, I will buy. Okay, let's say, for example, if it is 2.2, then what is the incentive for me to exercise? If I buy at 2.2 and I can sell into the market at 2.2, can I say there is no incentive? So it is called at money. It is called at money. I may or may not exercise. I've got no incentives. I'm going to get no advantage in terms of buying. So it is at money. Now, let's say if it is 1.8, would you be interested to buy now? If you go to buy at 2.2 and then sell it in the market at 1.8, you will suffer a loss. So I am not likely to buy. So can I say it is called out of money? So you can see that I have taken a case where it is in money. You're saying, yes, likely I'll buy. It's at money, indifference, and it is out of money. Likely I'm not going to buy. Now, if it is 1.2, tell me, are you likely to buy or you're undoubtedly not likely to buy? If you're going to buy at 2.2 and the prevailing market price is 1.2, I'd say, boss, that's too much of a loss for me to buy. So this is what you can say is deeply out of money. It is deeply out of money in this case. And if you consider the situation of 4 lakh rupees, can I say in this case, I'm saying, wow, if I buy at 2.2, I get the opportunity to sell it in the market at 4 lakh. So this is called deeply in money. I will say, wow, I am highly likely interested to exercise. Now, let me say something, friends, at this stage, and you can vouch me on that. Can I say the only situation where I would say undoubtedly I will exercise? I'm saying the only situation where I'm undoubtedly saying I will exercise is the fifth one, when it is deeply in money. In the first 3 cases, I'm not, 100% certain. If it is in money, I'm not 100% certain that I will buy. If it is out money, I'm not 100% certain that I may not buy. But the only case where I'm saying that I will definitely buy, it is a case when it is deeply in money. When I know it is deeply in money, I will say 100% let me repurchase. Did you get my point? So now I think let's go back and look at the language out here. Sale of the financial asset together with a put or a call that is deeply out of money. That is deeply out of money. If you can prove it to me that your option is deeply out of money, you are 100% almost sure you will not buy. So you made a sale, and if it is deeply out of money, you will not repurchase. You will not repurchase. So it is as good as a sale. The risk and reward is being transferred. So you need to prove it to me that it is deeply out of money. Option that is so far out of money, highly unlikely to go, it says in the money before expiry. So you are undoubtedly sure that, in this particular case, it is highly unlikely that I will exercise the call option. So I am not going to exercise because it is deeply out of money. Did you get the funda? Am I clear with the concept of what is the concept of deeply in and deeply out in this case? Correct? Now, let's, I think, go further. Let's, I think, go further in this case now. Now, let me go back and come back to the inputs. Now, I'm going to change the arrangement. I'm going to change the arrangement to a put option. I'm going to change the arrangement to put option. Now, watch this carefully. Just adding another example out here. So let's say there is A Limited and let's say there is B Limited, and A Limited made a sale. Let's take the same figures. A made a sale of a financial asset, let's say at a value of 2 lakh rupees. And then see, watch this carefully. See the arrow where I'm taking. B goes for a long put. B goes for a long put. Now watch this carefully. Here I said A goes for a long call. I said A goes for a long call. And in this case, I said B goes in for a long put. So can I say what is a long put for B is supposed to be a short put for A? Is my thoughts correct? Because many people tend to get confused. They say, sir, the put for the other fellow is a call for me. No, a call is a call for both parties. A put is a put for both parties. The party which gets the right to buy is a long call. The other one is a short call. The party which gets the right to sell is a long put, and the other party is a short put. So in this particular case, B says that I want to enter into a long put where I will get the right to sell it back to you. and A is under an obligation. A is under an obligation. If B says, okay, I will sell it to you, A will say, okay, sir, that's fine. I'll abide by the contract. So let me first ask you, is the situation where A goes for a long call and the situation where B goes for a short put, is it effectively the same? When A says a long call, he sells and he gets a right to buy back. When I say A sells and it is a short put, he is under an obligation to buy. So can I say whether A takes a long call or A goes for a short put, effectively isn't the deal the same? Because A gets a right to, right to buy it back, or A is under an obligation to buy it because B has got the right to sell it to A. So a long call for A is as good as a short put for A. Am I making sense, friends? Okay, so now with this input, let's see further. In this case, when B gets a long put, who will decide whether the option will be exercised or not? B will decide whether the option will be exercised or not. Because B has got a long position, he is paid a premium to A, and he will decide whether I want to exercise the option or not. So in this case, he will decide. So let's consider that the exercise price of this option is, let's say, 2.2 lakhs. And let's consider some permutation combinations. Let's say the expected market price. Let's say the expected market price. Let's take some few combinations. Let's say the expected market price is 2.8. Let's say it is 2.2. Or let's say it is supposed to be 1.8. And then we can take some different prices. Let's say it is 4. And let's say it is 1.2. Almost taking the same figures. Now let's understand this. Now you have to decide. B tells A that I will sell you at 2.2. Now please tell me, if the market price is 2.8, will B sell to A? B told A that I will sell you at 2.2 lakhs and the market price is appearing at 2.8. Do you think B is going to sell to A, or he will say, no, I'm not interested? Tell me. So in this particular case, when I am going to consider this case, what would be the situation? And that's right. So at 2.8, he will say, no, I am not interested to sell. Can I say in this case, he will say, I'm indifferent to sell. So can I say this is out of money? Can I say this is at money? And what about the third situation? If the price in the market is 1.8, B will go to A. Yes, I want to sell you at 2.8. So it is supposed to be in money. And what about this 4 lakhs? And what about this 1.2? At 4 lakhs, can I say it is deeply out of money? It is deeply out of money. And at 1.2 lakhs, it is again deeply in money. It is supposed to be deeply in money. Can I say the only case where I can be undoubtedly assured that B will sell it to A is when it is deeply in money. The only case where I'm undoubtedly sure that B will not sell to A when it is deeply out of money. I guess I stand clear. So I can say when it is deeply in money, B will definitely sell back to A. And if it is deeply out of money, B will definitely not sell it back to A. That means it's a sale where there is going to be an option to buy, but nobody is going to buy it. Because effectively, if it is deeply out of money, then the case of repurchase will not happen. The sale is made, and it's the end of the story. So now if you come back and see the language completely, you can now connect the dots. A sale of a financial asset with a short put. A sale of a financial asset with a long call. It's nowhere written it's a short put or it's a long call. We need to interpret this on our own. So when you say that it is a case of sale with a long call or it is a case of sale with a short put, so we can say both situations are same. If it is deeply out of money, then you can say the risk and reward is substantially transferred. And you can see the vice versa. If it is a case of sale with a long call, and if it is a sale with a short put, and it is deeply in money, the risk and reward is not substantially transferred. Let me show you that as well. So we can just have a look out here. Let me just crop this bit. So we can see out here, the inputs are given out here. So this is another agenda. It says sale of a financial asset with a deep in money put or a call option. So if it is deep in money, then in that particular case, we can say the risk and reward is not substantially trustworthy. So this is getting too technical. Don't worry, I'll just, club that up everything. So we have decided in which cases do we say the risk and reward is substantially trustworthy, and in which cases we say the risk and reward is not substantially trustworthy but substantially retained. If you say it's an unconditional sale, substantially trustworthy. If you say it is a sale of the asset and there is a repurchase at a fair value on the repurchase date, substantially trustworthy. If you say it is a case of sale with a long call that is deeply out of money, substantially trustworthy. When you say it is a case of sale with a short put which is deeply out of money, I would say it is substantially trustworthy. So you need to be clear of 4 situations which are given in the standard where you can say that it is definitely trustworthy. Unconditional sale, done. A sale with repurchase at a fair value on the repurchase date, done. A sale with a long call deeply out of money, done. A sale with a short put which is deeply out of money, done. In all these cases, the risk and reward is substantially trustworthy. Now, which cases the risk and reward is not substantially trustworthy but is substantially retained? So you can say if it is a sale with a short put which is deeply in money. Number 1, then you can say a sale with a long call which is deeply in money, and that is also a case where it is going to be sold for sure. 1 or 2 more situations in this case. It says a sale and a repurchase transaction where the repurchase price is a fixed price or a sale price plus a lender's return. I sell the asset to you at 2 lakh rupees today and I buy the asset from you at 2.2 lakhs. It's basically a loan. If A in this case sells an asset to B, let's say at 2 lakh, and he says, I will repurchase at 2.5 lakhs, for example, it's not a sale. It is a loan. A has taken a loan of 2 lakhs from B, then he's returning the principal with an interest of 0.5 lakh. So a sale and a repurchase at a fixed price, or it is at a price which is a selling price plus a lender's return, that is considered to be a case that it is substantially retained. So then which are the cases where it is substantially neither trustworthy nor retained? All those call and put options which are in money, at money, out of money, they are the cases where you can say it is neither substantially trustworthy nor substantially retained. In that particular case, you need to go to the step number 3, which is control test. So this is getting more heavier. Let me just connect the dots once again. I'm now going to give you a list of all those cases where the risk and reward is substantially trustworthy, 1. The risk and reward is substantially retained, 2. And the risk and reward is neither substantially trustworthy nor substantially retained. So we are absolutely clear that, okay, in this combination, this is what we decide. Let's, I think, pen this down. So I'm going to first pen this down out here. So let's put now the step number 2. So we are working now on the step number 2, which is on the risk and reward test. Which is on the risk and reward test. After all these tests are done, I'm going to give you a wonderful mind mapping chart of all the permutation combinations, deciding the kind of accounting which will apply. Once that is done, then we push on to the accounting to be done. So this is risk and reward test, and we're looking at 3 permutations and combinations. So we want to look at the situations when it is substantially trustworthy, when it is substantially retained, and it is neither. So we want to see when it is substantially trustworthy, I want to see when it is substantially retained. And I want to see that if it is neither substantially transferred nor substantially retained, how does the permutation combinations look like? Okay, so let's give you the list of items where we can say it is substantially transferred. Number one, it's an unconditional sale. It's an unconditional sale, no ifs and buts. So if A made a sale to B without any ifs and buts, it's an unconditional sale in that case. The next situation is we can say it is a sale and repurchase. It is a case of sale and repurchase, and we can say the repurchase price is equal to fair value on repurchase date. It is equal to the fair value on the repurchase date. So if this be the case, then also it is substantially transferred. Number three, if it is a sale plus a long call, if it is a case of sale plus long call, and if it is a case of sale plus a short put, and in both the cases, we can say it is deeply out of money. It should be deeply out of money. So what is important is that it is deeply out of money in these two cases. A sale with a long call deeply out of money means that you're not going to buy it back. You're not going to buy it back. A short put where you're saying is deeply out of money, the other person is not going to sell you back. So in these cases, we can say the effective sale has occurred. Then the next agenda, we're looking at substantially retained. So one is, you can say sale plus a repurchase, sale with a repurchase, and this repurchase price, the repurchase price is equal to, you can say either a fixed price, it is either a fixed price, or we can say it is selling price plus lender's return. So he is charging you indirectly interest. So this is the case. The repurchase price is equal to the fixed price, or we can say selling price plus a lender's return. And number two, we can say it is a sale plus a long call, or we can say it is a sale with a short put. And in both the cases, it is supposed to be what? Can I say this is supposed to be deeply in money? This is supposed to be deeply in money. So if it is deeply in money, then there is a guarantee that yes, the other party is definitely going to buy and sell. So you need to remember that only cases where we can say it is substantially transferred is deeply out and substantially retained deeply in. And therefore, the remaining situations will come out here. So we can say in this case, we will have sale plus a long call, or we can say it is a sale with a short put. It is a sale with a short put. And would you like to tell me which combinations will work in this case? So when you look at this, which combinations will work in this particular case? Can I say the combinations working in this case will be in, at, out. So this will be a situation where it is in, where it is at, or it is out of money. So in these cases, we cannot conclude that it is substantially transferred or substantially retained. It would be a case of neither. Well, so is this portion clear, friends, to you? I hope the concept of deeply in, deeply out and all is clear. So then we can proceed further. So were you confused, sir? Please clear it on the chart. Okay, nobody. Let me, I think, explain this. So I think I need to explain you a bit more about options, because I think the understanding of the options might be a little more backseated, right? You want me to explain slowly the concept of put and call options so that this chart becomes absolutely clear? Yes, I think. But still tell me yes or no. I feel it is a little apprehensive. Some people may not be very strong about the concepts of calls and puts, and in terms of in and out, deeply in and out. You want me to explain that part? Okay, so I think no, not required, sir, but I think somebody was confused. I think, Manish, you want me to put this if you want to get this clear? Because I think unless you got strong inputs on what is call, put, long, short, in, at, out, the options concept, you can't really appreciate this particular chart. Okay, I didn't get any inputs on this from you. So I presume that in that case, everybody's clear with options. But I'll just simply, give you some quick inputs, quick thoughts, and connect the dots out here. So I think first thing, what we need to understand at this particular stage. Now be very clear on one thoughts. If I enter into a call option, now please hear this very carefully. If I enter into the call option, this goes for people who might be, not having a very good knowledge on options, on derivatives. Now, if I enter into a call option and I pay a premium, I take a long position and the other party takes a short position. So in this example, when A pays a premium to B, A takes a long position and B takes a short position. The person paying a premium will always get a long position, a right of refusal. And the person getting the premium is always under the obligation of the other party. So if A says, I want to buy, B will say, okay, sir. If A says, I'm not interested to buy, B will say, okay, sir, because he's taken a premium, so he is under an obligation to obey the orders of A. That is one thing you need to keep in mind. So when A pays a premium to B, A is long position and B is a short position. So number one, what you need to remember, A pays a premium, long position, the other party short. Number two, when A says, I will buy, it's call for A, it's call for B. So in this case, when A said, I want to buy from B, it's a long call for A, it's a short call for B. So A pays a premium and says that I'm interested to buy, but I will decide at a later stage whether I'm interested to buy or not. Now you need to understand another important aspect, that in this case, if A tells B that I will come and buy it back, the sale has not occurred. The sale has not occurred, because if A says today I'm selling you the asset and tomorrow I'm going to buy the asset back from you, where is the sale? If there is no sale, the risk and reward is not transferred in that case. So what do you need to prove in order to say that the risk and reward is substantially transferred is you need to prove that I am not going to repurchase it back. We need to prove it that I'm not going to repurchase. So in these cases, A needs to prove that even though he's got a long call to buy, he will not exercise the long call. He will not repurchase. If he's not going to repurchase, that means you've done the sale. The risk and reward has already got transferred in that case. So when do you exercise a long call option? When the market is bullish in nature. When the market gets bullish in nature, it is at that stage you decide that, okay, I will exercise. So you can see if the exercise price is 2.2 and the market price pushes up, it goes bullish, I am interested in buying, but I can't undoubtedly say that I will buy, because the price is a little more than the exercise price, but it doesn't confirm me that I'm going to buy. So the only case where you can say that I will definitely buy when the market price is much more than the exercise price. If the market price is much more than the exercise price, I'll definitely say, yes, I am highly likely to buy. And if the market price is very less compared to the exercise price, I am highly unlikely not to buy. So the only case where I can say with a conformity that A will not buy, A will not buy when it is deeply out of money. And the only case where I can say that A will definitely buy when it is supposed to be deeply in money. Am I clear at this stage? You should be very clear that when A will exercise the option to buy. So A will exercise the call option for sure when it is deeply in. A will definitely not exercise when it's deeply out. Now, if A will make a sale and not buy, then I can say risk and reward transferred. If A will make a sale and will definitely buy, that means sale has not occurred, then the risk and reward is retained, because you're going to definitely buy it back. The sale has not occurred as such. It's a sale, but you're going to definitely buy it back. So in that particular case, risk and reward is retained. So we decided the case of call option. Now, if you go to the put option, now put options, you need to understand when A is got the right to buy, A will repurchase. Now, in this case, I'm taking an opposite case. B says, I will sell it back to you. When B says, I take the right to sell it back, B enters into a put option. He pays a premium to A. He pays a premium to A. So for B, it becomes a long put, and for A, it becomes a short put. Because ultimately, there are two ways where the asset comes back to A. Hear this carefully. When A buys it back, it comes back to him, or B sells him, then also it comes back to A. So the concept of long call can be equally applied to the concept of a short put for A, where B says, I have the right to sell it to you, and A says, okay, I'm under an obligation to buy it from you. So it's a short put. Now, when is a put option exercised? When the markets are bearish in nature. When the markets are bearish in nature, when the prices are coming down, it's only B will exercise. So B will exercise in which case? Where the exercise price is 2.2 and the market price is falling down substantially, he is highly interested to exercise. He will go to A and tell him that, yes, I've come to sell it to you. So the sale will take place and then the repurchase will take place. So if it is deeply in money, B will sell it back to A. So the risk and reward is not transferred. But if it is deeply out of money, B will not sell it back to A. If it is deeply out of money, B will not sell it back to A. So in that case, the sale has occurred. So four things which you need to keep in mind. If there is a sale with a long call, deeply out of money, transferred. Sale and a long call, which is deeply in money, retained, substantially retained. Similar to the other two cases, it's a sale with a short put, deeply in money. It is retained. And if it is supposed to be short put, sale with a short put, which is deeply out of money, in that case, it is a case of transferred. So I pen this down and you can see the cases where there is a sale and a long call, or a sale and a short put, and it is deeply out of money, the repurchase will not occur, it is transferred. Whereas a sale and long call and a sale and short put, and it is deeply in money, the repurchase will take place. Therefore, it is retained. But if you say it is sale and long call and sale and short put, and it is in at out money, I don't know it may occur or not. So I'm saying it's neither transferred nor retained. You're in between the two situations. I hope I now stand clear on the agenda. I hope I am very clear on the thought processes now. Manish, I think you had put a question. Sir, but please save the last 10 minutes for doubts. Of course, we'll do that. That's not a problem. Okay, now it's clear. No questions. That's wonderful indeed. Okay, so we made a list of the step number 2 as well, but we're now on the step number 3. So now you're clear with the cash flow test in terms of expired, in terms of transferred, in terms of PDA. And now we are also clear in terms of the risk and reward substantially transferred, substantially retained, and neither substantially transferred retained. Now comes the control test. Now we need to go to the next one, and that is the control test. So let's see what is the concept of the control test. So I think let's now take you to the control test. So this is the control test. I guess we can have a look at this particular chart, which explains the concept of control test in the study. You know, after all these parameters are done, then comes the next agenda where we are required to do the accounting of those combinations as well. But no worry, that will be taken care. Let's come back. Whether the entity has retained a control depends upon the transferor's ability to sell the asset. Well, a control test means what I simply call it as decision-making rights for the other party. A made a sale to B, and the risk and reward test is neither. We go to the control test, and therefore now I start evaluating, is he a free man to sell it further? If he wants, can he sell it further? If he's got the practical ability to sell the asset further, control is transferred. How would you decide that if A made a sale to B, how would you decide that B is got a free choice of making a further sale? If there is an active market for the financial asset, he can sell the asset. Tomorrow, if A comes back to him, B can buy it from the market and give it back to A. Please hear this carefully. Today, A made a sale of asset to B, and B made a further sale because there is an active market for the asset. Tomorrow, A comes back to B and say, no, 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 I want the asset back. I want to repurchase. So B says there is an active market. He goes to the active market, buys the asset and gives it back to A. So everything will depend upon the presence of the active market in terms of the control test. So in this particular case, what you need to see is you need to see the presence of the active market. So I'll put it in short. If you say that there is an active market, if you say there is an active market, I would say in this particular case, the control test is passed. You have transferred the control test, derecognition. But if you say the active market does not exist, then I would say the control is retained and it's a case of partial derecognition. Okay, so I think let's pen this down as well. So I'm going to put this now, another inputs out here. This is my step number 3. So we're now looking in terms of the third step, and that is the control test. And in terms of the control test, there are only 2 possibilities which can be worked out. And I think we're just going to put a simple little question to ourselves to decide the control test in this particular case. And that is, we're going to put a question. Is there an active market? Is there an active market for the financial asset? Is there an active market for the financial asset? So if you say yes, there is an active market, or you say no, there is no active market. If there is an active market, then we can say the control is transferred. And if you say no, there is no active market, then we'll say the control is retained. And you already know that if the control is transferred, you can go for a derecognition in this case. And if it is retained, it would be a case of a partial derecognition, not a case of continue, but a case of partial derecognition. Now let's, I think, connect the dots further at this stage. Now, as I make a walkthrough on the 3-step model, you need to be clear what is expired, full and final settlement, transferred, sale, assigning the trade receivable to factoring agency, getting bill discounted. PTA, 3 conditions. You will pass on whatever is collected, nothing more, and you will pass on without any material delay. You cannot sell or you cannot pledge. Cash flow done. Risk and rewards, the cases where it is substantially transferred. There is an unconditional sale, that's one. There is a sale with a repurchase at a fair value. There is a sale and a short put, or a sale and a long call, and it is deeply out of money. The cases where the risk and reward is substantially retained, that is a case where there is a sale and a long call, or a sale and a short put, which is deeply in money, or the sale is at a sale and repurchase is at a fixed price, or it is selling price plus a lender's return. And the cases where it is neither sale and long, sale and short put, and it is in at out money. You reach the control test. If there is an active market for the financial asset, transferred. If there is no active market, it is not transferred. And that's how the combinations will cover. Okay, so I think what I want to do now at this stage is give you some permutations and combinations. I think we'd like to make some interesting chart at this particular stage, which will give you the idea of what kind of accountings would apply. If you're able to answer this particular chart, then I think you've got the concepts, the first stage correct. Then will come the concept of accounting for these 3 kinds of derecognitions. Let's now make an interesting chart to you. So I'm going to make a comprehensive chart, a summary chart of all the permutations and combinations. Maybe I don't create all the permutation combinations, but a little comprehensive view of all the permutation combinations to decide. So let's make an interesting chart. I'm going to give you combinations. One column for particulars, one is for the cash flow test, one is for the risk and reward test, one is for the control test, and one is the remarks to be given whether we are going to go for a derecognitions or not. Let's, I think, begin the journey. So I am looking at the particulars, where I'll give you some details. Then I'm looking at the step number 1, cash flow test. I'm looking at the step number 2, risk and reward test. I'm looking at the step number 3, that is control test. And I'm looking at the remarks, basically in terms of the accounting which is to be applied. Is it full derecognition? Is it partial derecognition? Or is it continuation of the asset? Let's begin with some very simple inputs to you. So get ready to answer questions on this. If I say the cash flows, if I say there is a full and final settlement, F and F. So start giving me answers, friends, on that. What do you say? The cash flows are what? Okay, I'm getting a question, sir, but this assessment may be changed subsequently. For example, when we sold with an option, it was deeply in money, but subsequently it may change. Yes, it can, but I think we will not get into that technicalities from the examination point of view. So what you're saying is correct. It is quite possible. We'll not get into all that. Okay, so that's right. So can I say if it is a full and final settlement, the cash flows are expired? There is no need to apply the risk and reward and the control test. Can I say it is a case of a full derecognition? Wonderful indeed. That's right. Let's go for the next combination to you. Let us say there is an unconditional sale. Let's say there is an unconditional sale. So what has happened to the cash flows? Expired, or is it supposed to be a case that it is transferred? It's a sale. It's a sale, which means the cash flows are transferred. And since it's an unconditional sale, we can say it is substantially transferred and the risk control test is not applicable. So can I say it's again a case of full derecognition? Wow, that's great. Let's take a third combination as well. Now we'll take some interesting combinations and let's consider there is a bill receivable discounted. There is a bill receivable which is discounted. Then I'll take another case as well. I'll take 5 cases and give you some permutations and combination. Okay, if the bill receivable is discounted, then the cash flows are transferred. What do you say about the risk and reward? Let me tell you that in case of bill of exchange, when you get the bill discounted from the bankers, can I say, does the risk pass on to the bankers? If the customer does not pay, is the banker responsible or are you responsible still to the bank? So do you think the risk and reward is substantially transferred or is it substantially retained? I think it is undoubtedly that it is substantially retained. If it is substantially retained, I don't need to apply the control test, but you can say the asset continues. And let me tell you that once the asset continues, you are going to record a financial liability in the books. The entry will be bank account debit and financial liability gets a credit. I've said that earlier as well. So in this case, continue means recognizing a financial liability. Now let's take the case where you assign your trade receivables to a factoring agency. Now watch this carefully, friends, because I'm going to give you 2 situations in this case. One is called recourse and one is called non-recourse. So there are 2 cases. One is a recourse and the other is a non-recourse. Now hear me carefully. When I go to the factoring agency and I tell them that there is a recourse, recourse means I go to the factoring agency and tell him, if my customer does not pay me, you can catch my collar. If my customer does not pay me, you can catch my collar. So is the risk and reward substantially transferred or substantially retained? So in this particular case, what do you say? Risk and reward substantially transferred or retained. I'm telling the factoring agency, if my customer doesn't pay, you catch me. Non-recourse means if my customer does not pay, sorry, sir, it's your problem. You take care on your own. And that's right. So if it is a recourse, the cash flows undoubtedly transferred. That is one. And the other one is this is substantially retained and no control test, then in this case, again, the asset continues in the books of accounts. And if you say it's a non-recourse, it is transferred, and this is substantially transferred because it's not my risk, and therefore a full derecognitions would take place. You can see the combinations which I'm doing: full and final, unconditional sale, bill receivable discounted, and assigning the trade receivable. Let's now create the combinations of long call and short puts as well. Let's continue with this chart and let's consider 5 columns. So let's add some more combinations to this. So this is particulars, the cash flow test, the risk and reward, the control test, and the accounting. So this is number 5. So here we're going to create some interesting combinations, particulars. Then let's take the step number 1, step number 2, step number 3, and let's decide the kind of accounting. Now this is interesting combinations to watch. Okay, now I am considering that there is a sale and there is either a long call or it is a case of short put, either of the two. And I'm looking at now some interesting situations. It is deeply out. It is deeply in. It is deeply in, or it is in at out. It is in at out. Now watch the combinations carefully. If you're able to get this chart now, that means you've understood the broader principles of how the derecognitions will occur. Okay, now let's consider that if it is deeply out in all, can I say in all these cases, the cash flows are definitely transferred. Now let me ask you, if it is deeply out, is the risk and reward substantially transferred or retained? There is a sale and the call option or the put option is deeply out of money, not to be exercised. So what do you say? Right, so in this case, it is substantially transferred, great. And if it is deeply in, can I say substantially retained? No control test in this case. Transferred means full derecognition. Retain means that we continue the asset in the books of accounts. Okay, now finally, if it is in at out, can I say it's neither? Now what do you need to do? Consider the control test. Now, everything now depends upon that is there an active market? Is there an active market or there is no active market? If there is an active market, then we can say it's a full derecognition. And if there is no active market, it is going to be a partial derecognition in this case. So all these permutation combinations are now addressed. I think now we are clear in which combinations, which accounting would get triggered. So far, so good, friends. We're going to apply this, see this in some questions also. But now this chart brings us to the input that there are 3 kinds of accounting. Full derecognition, how the accounting is done. We'll be seeing that. Partial derecognition, how that accounting is done. And if there is a continuation of the asset, how it is done. So we've given some questions in the study material where they tackle the case of full derecognitions as well as the case of a partial derecognition. I think the case of continuation has been discussed, I think conceptually. There's no question as such, but I think we can just take the case of bill receivable in that case. But I think it's time to first give you some break at this stage. We'll do these 3 kinds of accounting post the break. And then we also need to consider the derecognition of financial liabilities after that. But first, I think we need to do the accounting. I know today's session must be very heavy indeed because this derecognition is a very complicated affair. But yes, you can see questions in the exams which are asked on the derecognition concept as well. Okay, so I think let's give you a break, friends, at this stage, 10, 12 minutes, so that we can commence back. Please relax your minds. Okay, thank you. rest of mind and just connected the dots as well in terms of all the combination of tests we have done. I think now we're ready in terms of applying this to a practical aspect as well. Because now we know which combination leads to what kind of accounting. Either it's a full derecognition, or it's a case of a continuation of the asset, or it's a case of partial derecognition. How does these three kind of accountings apply? Now let's have a look. We're going to take up some questions in the study material now. Okay, let me, I think, share this. So we are now talking in terms of three kinds of accounting. And I'll just take you one by one to all these three kinds of accountings which are given. Let me just scrub this to give you a better picture. So a couple of illustrations are given covering all these three kinds of accounting one by one. So let's begin the journey. We're looking at the first accounting category. So I hope that is visible. So first, I'll just show you the basic flow and then proceed further. I think I got a question as well from Ayush. So in case of deeply in the money, if the risk related to bankruptcy of the instrument issuer is transferred to the buyer, then why is it called a credit risk? Why the credit risk is not transferred? Okay, you're talking of a risk and reward where the bankruptcy of the issuer gets transferred to the holder. Okay, I think we'll not get into that part immediately. I think that becomes more again a consulting issue. Just wait on for that moment. We'll come back to it. I'll leave some time today at the end of the class, around 10 minutes or so, where you can put across your questions. I think one or two more requests have also come in. So we'll take those, questions out there, because these kind of questions might actually, take you to various branches in between. So no worry. We'll take those things, I think, at the later stage. So the first thing you can see is that we are given the transfers that qualify for derecognition. So I would say this is a case of a full derecognition. This is like case number one. Now let's read about the full derecognition. It says if the arrangement results in a derecognition of the asset in its entirety, that means 100%. It says in case of assets included at FPT-OCI category, any gain or losses previously recorded in equity is recycled to the statement of P&L as per the requirements of the standard. He's typically talking of FPT-OCI, that is R. He says if the financial assets are measured at FPT-OCI R, any accumulated balance which is there in the tab number 3 of SOKI is going to be recycled in the P&L. That we already know that earlier. And then it says any new financial assets obtained or financial liabilities assumed. I'm not reading everything. It says they're recognized at a fair value. So if there is any other financial asset obtained or financial liability assumed, you need to recognize them at a fair value. And then let's go further. Then he says further out here, so then he says the difference between the carrying amount and the consideration received is recognized in the statement of comprehensive income. Well, if you ask me to put a simple entry in terms of a full derecognition, I would put like this, that the entry will become bank gets a debit, financial asset gets a credit, the financial asset gets a credit at a book value, the bank is with the proceeds which are received on the sale, and any balancing figure in this entry will be taken in the P&L. Or if it is a case of, let's say, equity instruments, which are measured at FPD-OCI, then it can go in the P&L. So any difference will go to the P&L generally, except those equity investments. And if there is any accumulated balance which is there in terms of SOKI, you need to see whether it is a case of R or NR, and you have to accordingly take care. Nobody will make some pen down some notes major later. But if it is a case of full derecognition, you put the entry bank with a debit, that is with the proceeds received. The financial asset gets a credit at the book value. Any difference between the consideration received and the book value of the asset is going to be taken in the P&L generally if it is a financial assets other than FPT, OCI, NR. In all cases, it goes in the P&L. It goes in the OCI if it is FPT, OCI, NR. Accumulated balance in SOKI depends upon R, NR. If it is a case of R, it will go to the P&L. If it is a case of NR, it is directly transferred to the tab number 2. So we'll pen that down as well. So full derecognition would mean passing the entries and taking care of the respective amounts in the tab number 3 as well. Okay, let's have a look now at illustration number 11. So we'll see the illustration 11. Now, as we read illustration 11, please apply your thoughts. We'll see the cash flow test, we'll see the risk and reward, we'll see the control test if required, and then reach a conclusion that whether it is a case of full derecognition or a partial derecognition or a continuation of the assets. Let's have a look. It says ST assigns the trade receivable. Now tell me, if it is assigned the trade receivable, quickly tell me, is the cash flow expired or is it transferred? Let's, I think, get this inputs quickly from your end. The question says that we've assigned the trade receivable. You went to the factoring agency and you assigned your trade receivable. Cash flow expired or is it transferred?
Transfer.
That's absolutely correct. So the cash flows are transferred. So we need to go to the step number 2. Great. The carrying amount of the receivables is given. The consideration received is 9 lakhs. Customers have been instructed to deposit the amounts directly in the bank account for the benefit of AT. AT has got no recourse to ST in case of any shortfalls in collection. What do you say about the risk and reward? If there is a no recourse arrangement, then what do you say? Risk and reward is what? Transferred or is it
Substantially transferred?
That's right. It is substantially transferred in this case, because I've already said that if there is no recourse, that means in this case it is substantially transferred. No need of the third step. So what is the conclusion? Is it a full derecognition, right?
Full derecognition.
That's absolutely correct. So it's a case of a full derecognition in this case. So let's see, state whether derecognition principles will be applied or not. Now let's read the answer. ST has transferred the contractual cash flows and has also transferred substantially all the risk and rewards, the credit risk being the most significant risk in the situation. So you can say the risk and reward transfers the credit risk of non-payments as well. Accordingly, ST recognizes the financial asset, recognizes 1 lakh, difference between the consideration and the book value as an expense in the P&L. So what is the entry which we're doing in this case? Bank gets a debit, can I say to the extent of 9 lakhs? The financial asset gets a credit to the extent of book value, that is 10 lakh. And can I say this 1 lakh is going to be debited in the profit and loss, that is a loss arising on a derecognition. I think now you can simply see the language of the question and decide that the principles applied tells me it's a case of complete derecognition, and therefore a journal entry for a full derecognition is done. Bank gets a debit with the consideration collected. FA gets a credit to the extent of book value, and the difference is a profit or loss on derecognition, which is generally taken to the P&L except equity investments, FPD, OCI, NR. Right, friends? I hope so far so good. Now, this is the first case. This is the first case. So this is the case number 1, that is a complete derecognition. Now we go to the next case, and this is the case number 2. This is the case number 2, which is it do not qualify for derecognition, which means the financial asset will continue in the books of accounts. And this is case 2 where it does not qualify for derecognition. Now you will remember, and I told you, I'll also recall and tell you that as well. Remember when we were doing the concept of financial liabilities, I segregated the financial liabilities in various categories. And one of the financial liabilities was FPTPL, where I said that those financial assets which are not eligible for derecognition, it results in a creation of a financial liability. So in this particular case, that's what is going to happen. If a transfer does not result in a derecognition because the entity has retained substantially all the risk and rewards of the ownership, then he says you continue to recognize the transferred asset in its entirety. Recognize a financial liability for the consideration received at a fair value less any TC. The liability is subsequently measured at AC using the effective interest rate. Now, in this particular case, I think if you look at the status, when you discount a bill of exchange, for example, when you discount a bill of exchange for that example, so what you're going to do, you cannot put the entry bank debit, bill receivable credit. You're going to put the entry bank debit, financial liability credit, and it's recognized at fair value less TC. So let me put this question to you. Does this mean that if there is a bill of exchange of 2 lakhs and there is a 20,000 which is a discount, can I say the entry bank debit FL credit will be at 1 lakh 80? The net proceeds, the fair value minus the transaction cost, correct?
Yes, sir.
Absolutely. And then it says in the subsequent periods, recognize any income on the transferred asset. So there's no example which is given in the study regarding this, because this would be a simple entry, bank debit FL credit. So I think I'll put the entry across. I'll make the notes later, no worry. So bank gets a debit and the financial liability gets a credit. And this is going to be recorded at fair value minus the TC. This is the case number 2 when the asset continues in the books of accounts. Now let's come to the case number 3, which is a little complicated one. And that is called a case of partial derecognition, or is also called a case of continuing involvement. Let's have a look at now the case number 3. So there is one illustration which is going to run across, and I'm going to take you deep on that. Then I'll make some notes on the accounting treatment as well. Don't worry on that. It says continuing involvement in the transferred asset, that's called partial derecognition. You call it as a partial derecognition or you call it as a continuing involvement, one and the same thing. Now, it's going to be a little easy to explain you the concept with a practical example. So instead of reading the theory on the case 3, I'm going to run a practical example with you. So there is an illustration 12ABC. So we're going to see the illustration number 12ABC, and we're going to see connect all the dots. Okay, let's, I think, have a look out here. Let's read. Illustration number 12A, it says there is a debt factoring with a recourse continuing involvement asset. Now, this is going to be technical for the next 5 minutes. You will say, oh my God, what is happening? I did not understand. Don't worry. I will connect all the dots very carefully. So next 5 minutes, little crucial. It says entity C agrees with a factoring company to enter into a debt factoring arrangement. Under the terms of the arrangement, the factoring company D agrees to pay 91.5 crores less a servicing charge 1.5 crores. So they give them a net 90 crores. In exchange for 100% of the cash flows from the short-term receivables. Now let me, I think, first ask you the question. Let's apply the cash flow test. When you went to the factoring agency to assign your trade receivable, is the cash flow transferred or is it expired?
Transferred.
Wonderful indeed. So we can say since you entered into the agreement with the factoring agency, the cash flows are transferred. Now see what it says. The receivables have got a face value 100 crores and a carrying amount of 95 crores. The customers will be instructed to pay the amount in the bank account of the factoring company. Entity C also writes a guarantee to the factoring company under which it will reimburse any credit losses up to 5 crores over and above the expected credit loss of 5 crores. In my books of accounts, the debtors are captured at the book value of 95 crores. I have already considered a provisioning for doubtful debts where we apply the concept of expected credit loss. The company says that we've got a total debtors of 100 crores, but the book value is 95 crores, which means the company is created a provision for doubtful debts. We are expecting that 5 crores will be a bad debts. Now, what it says to the factoring agency, he says C also gives a guarantee to the company, the factoring company, where they will reimburse any credit losses up to 5 crores over and above the loss of 5 crores. They say that out of 100 crores, 5 crores we already accept that it is going to be a credit loss. We give you a guarantee for another 5 crores. Now tell me one thing. You are telling the factoring agency that I'll bear a loss up to 5 crores. You're limiting the amount which you will pay to the factoring agency. Do you think you're substantially trustworthy? Do you think you're substantially retained? Or by limiting the amount up to 5 crores, you're in a mixed situation of neither trustworthy nor substantially retained? What do you say? Making sense? That in this particular case, you're telling the factoring agency, I will be responsible, but it's not a case of recourse. It's a recourse with a capping, where you tell the factoring agency that I will bear a loss, but up to a certain extent of 5 crores. Since there is a loss which you're bearing and it has been capped, it has been limited to 5 crores, we can say the risk is neither substantially transferred nor substantially retained in this case. So we can say, if I look at the risk and reward, I would say it is a case of neither. So what do? We go to the control test. We go to the control test. Now, in this case, I am not given information regarding the control test is met or not, whether the factoring agency will be free to deal with those debtors the way it wants or not. So I assume that maybe no. I assume maybe no, which means the risk and reward is still retained. The control is still retained in this case. So if I say that the control is retained in this case, we are on the partial derecognition case. Now let's read further. The guarantee is estimated to have a fair value of 0.5 crores. Wow. If you remember, the financial guarantee given is supposed to be taken at a fair value, because we decided in terms of financial liability accounting that if there is a guarantee, it is initially captured at a fair value. So the guarantee has got a fair value of 0.5 crores. Calculate the amount of continuing involvement asset. Okay, now we are going to go to the complete picture and we're going to see the consolidate entry. So instead of 12AB, I'm directly jumping to 12C. Don't worry, I'll connect the dots further as well. Now let's, I think, have a look further on this, looking at the 12C illustration, combining and looking at all the entries. When it is a case of a partial derecognition, I will eliminate the asset and create a new asset that's called a continuing involvement asset. Now watch this carefully. Just see what I show you. The receivables is being derecognized completely. The receivables to the extent of 95 crores is completely derecognized. It gives you a feeling that it's a full derecognition. No, but I am going to record an asset as well. I am going to record an asset. You can see the continuing involvement asset. That's called continuing involvement asset, CIA. This continuing involvement asset is recorded at 5.5 crores. What is this 5.5 crores? That 5 crores, which is that you told the factoring agency, I give you a guarantee that I will bear a credit loss up to 5 crores. That is your involvement. And the fair value of the guarantee, which is 0.5 crores. So this is the amount of the guarantee, and this is, you can say, 0.5 crores, the fair value of the guarantee. So one is 5 crores, which is the amount of the guarantee, and one is that 0.5 crores, that is supposed to be the fair value of the guarantee. Now, The standard tells us that what is the amount of CIA. The continuing involvement asset is recognized at the lower of the two figures. It is taken at the amount of the asset or the guarantee amount, whichever is less. My involvement in the asset is equal to the lower of the two, the book value of the asset, or you can say the guarantee amount, including the fair value of that guarantee, which is 5 plus 0.5. So the continuing involvement asset gets captured to the extent of 5.5. Second, next, correspondingly, the company will also create an associated liability. You are basically going to put a contra entry. I'll split this in two parts. You're going to basically take a contra entry, the continuing involvement asset, and a same amount will be an associated liability. So the asset is partially there in the books of accounts and the liability is partially there in the books of accounts. So you can say the contra entry 5.5 is the associated liability. The cash is collected to the extent of 90 crores and 5 crores balancing figure is the loss on derecognition. You know what? I can say you can technically put across a total of 3 entries if you ask me, or 2 entries. I'll tell you what. The entries which you can pass in this case is first put the entry bank debit, financial asset gets a credit. This is 90 crores and this is 95 and the balancing figure goes in the profit and loss. This is exactly the entry which we did for a full derecognition. This is exactly the entry we did for a full derecognition. The bank gets a debit with the proceeds, the consideration received, the financial asset with the book value, and the profit loss on derecognition goes in the P&L. Then you entry that is continuing involvement asset gets a debit and the associate liability gets a credit. And this is to the extent of that 5.5 crores, the lower of the two figures which are there. The lower of the two figures which are there. And let me also take you back. If you go to the 12B, it says the amount of associated liability is lower of the two, is as below, sorry. The guarantee amount plus the fair value of the guarantee. The guarantee amount and the fair value of the guarantee. So effectively, you can see the asset gets eliminated at 95 crores, but a new asset at 5.5 crore comes and a liability correspondingly 5.5. This is called a continuing involvement. Now you would start asking me questions, sir, how would the accounting of this associated liability and the continuing involvement asset take place in a subsequent accounting? Not discussed in the study. I think they didn't want to take us to that particular level. So we are not looking at any subsequent accounting in this case. We're only looking at the accounting entries done at the stage of derecognition. Let me now connect the dots. If you say that it is a full derecognition, the entry is bank debit with a consideration, financial asset gets a credit with the book value difference in the P&L. When it is a case of continuing, the asset, you put the entry bank debit, financial liability credit at the fair value, less the TC, and then amortized cost approach continues. The third one is the case where it is a partial derecognition or a continuing involvement, do two separate entry. You do the entry for a full derecognition first of all, and then put the entry continuing involvement asset gets a debit, which is equal to the lower of the two. The amount of the asset, the carrying amount of the asset or the amount of guarantee, whichever is less. And the associated liability is nothing, but it is done with the same amount the continuing involvement is done. Now, let's, I think, give you something more to watch. You can see now the interesting thought process of the standard setters coming in. And I think that's what is important to understand if you need to understand the 3 kinds of accounting. Now watch this carefully. So you can see that the effective accounting is looking like this. Just imagine a T-shaped balance sheet. Let's say we're looking at 100% derecognition. Let's say we're looking at no derecognition. And let's say we're looking at a partial derecognition. So let us see the focus in terms of these 3 kinds of derecognition in terms of the balance sheet front to understand the implications. Now watch this. Let's say this is a T-shaped balance sheet. Let's imagine that this is a T-shaped balance sheet and see the impact on the balance sheet. So let's say there was a financial asset to the extent of 95 crores. Let's say there is a financial asset of 95 crores. So let's say in all these cases, let's look at the implications. What was the thought process of the standard setters in this case? Now, what's this? Now, first of all, when it's a case of 100% derecognition, you put the entry bank gets a debit to the extent of 90 crores. This disappears and the profit and loss gets a debit of 5 crores. Now, the question in this case is there any debt arising? No. If I am going in for untraditional financing, please mind the words. I am going in for an untraditional financing. For example, I assigned my trade receivable to a factoring agency with a non-recourse arrangement. What am I trying to do? I'm trying to create a financing which is untraditional financing. But then, I should be given an advantage. I basically gave my asset and got the money from the other person. If I sold the asset and got a money, then let me derecognize the asset. Don't ask me to show a liability in the books. So the company has gone in for arrangement of financing by selling off its assets. They had a trade receivable, they assigned it to the debtors, went in for a non-recourse arrangement. So I passed on the risk and reward. Let me just simply exchange an asset for an asset. I could bring in a liquidity, but the cost of bringing this liquidity is a loss of 5 crores. That is one. Second, if it is a no derecognition, I say, okay, you got 90 crores of money. It's fine, but you should recognize a financial liability of 90 crores. It is as good as a traditional loan which is taken. It is as good as a traditional loan. You assign your trade receivable and you tell the factoring agency that this is a recourse arrangement. He says, if your customer doesn't pay, I kill you. You're basically taken a loan from them. You could have taken a loan from the bank, but you've taken a loan from the factoring agency. Why would I allow you to remove the asset from the books? It's going to be looking as if you've taken a debt. In this case, it's not a debt. It's not a loan. It's a sale of the asset. So I don't disturb your liabilities in the balance sheet. But in this case, you have effectively taken a loan by considering your debtors as good as a security. So in this particular case, I'm asking the companies to show financial liability. And look at the next case where you said it is bank gets a debit. That is 90 crores. The financial asset disappears but appears at 5.5 crores. The associated liability appears at 5.5 crores and the P&L gets a debit to the extent of 5 crores. You can see that the pressure on the balance sheet is much lesser. Here there is no pressure in terms of debt. Here the pressure is got reduced and here there is 100% pressure. This is like a traditional loan and this is like, a very nominal amount of loan. Your liability gets increased by only 5.5. Here your liability gets increased by the entire consideration. Because here you are liable only for a certain amount. So in the case of a continuing involvement or a partial derecognition, I would not say that you can completely remove the asset. You can substantially remove the asset. And you will be allowed to reflect only a certain amount of liability. These three kinds of accountings will have different implications on the current ratios or the debt equity ratios in the company. And I think this was necessary to show you so that you can see the comparative position that when there is complete derecognition, no pressure on the balance sheet. When it is a no derecognition, it's a full pressure on the balance sheet. And when it is a partial derecognition, it is only a very less impact, very less pressure on the balance sheet in this case. I hope, friends, now you are able to connect some more dots. Let me make some notes now on these three kind of accountings as well. So far, so good. I guess you're able to now connect the dots in terms of how to decide the accounting, etc. Okay, so let's, I think, proceed with the inputs now. Let me just make an interesting summary chart of the accounting as well. So this is the second chart where we're looking at the accounting for derecognition of financial assets. Accounting for derecognition of the financial assets. So this is my second summary chart. The first one I gave you was on the principles That was on the principles of derecognition, applying the three tests. Once you've applied the principles and you reach a conclusion regarding the kinds of treatment, now let's see the three kinds of accounting. So we can see the three kinds of accounting. Once you've applied the basic principles and you reach a conclusion that it is a full derecognition, or it is a case of no derecognition, or it is a case of a partial derecognition, I'll now give you the journal entries which will be done in all these cases. And the partial derecognition is also called continuing involvement. It is also called continuing involvement. So let's see the journal entries now in these cases. If it is a case of a full derecognition, the entry in this case is bank gets a debit. Bank gets a debit with the consideration received, and the financial asset gets a credit, which is to the extent of book value. And you can say any balancing figure in this entry is taken to the P&L. Can I say except? The only exception is if it is a case of equity investments at FPT OCI, that is NR. This is the only exception where it is equity investments at FPT OCI NR, in which case it is the balancing figure goes in the other comprehensive income. And the other input which you need to watch out is that there is an accumulated balance in tab number 3. There is an accumulated balance in tab number 3. If it is a case of NR, it will be transferred to tab 2. It will be transferred to the tab number 2. And if it is a case of R, it will be transferred in the profit and loss. So this is the entire accounting in terms of full derecognition. The journal entry for derecognitions and the balancing figure gain or losses taken where. And if it is a case of accumulated balance in tab 3, if it is a case of R, it goes in the P&L. If it is a case of NR, it goes in the tab number 2. Now, when you say there is no derecognition, the financial asset continues. The financial asset continues in this case, and we put another journal entry, and that is bank gets a debit. Financial liability gets a credit. This is at the fair value minus the TC. And this financial liability subsequently accounted. It is subsequently accounted at AC, that is amortized cost approach. Okay, this is the second input, then the partial derecognition. So I would put two entries. One is bank gets a debit with the consideration received. The financial asset gets a credit, that is with the book value. And the balancing figure is again P&L, generally of course. Whatever is the balancing figure generally enters the P&L. And the second entry is the continuing involvement asset gets a debit and the associate liability gets a credit. This is equal to, you can say sum of, this is equal to the sum of number 1, lower of, we can say the book value of financial asset, or you can say the amount of guarantee, plus number 2, it is supposed to be the fair value of the financial guarantee. So this is going to be the sum total of the two figures. Number 1 is the lower of the 2, and number B is the fair value of the financial guarantee. Right, so this is the three kinds of accounting which is there in terms of financial asset accounting. So these are the three types of accounting. These are the three kinds of accounting related to the financial asset accounting. Wow. I think now it's time to ask for your scores as well on the accounting of financial assets in this case. Give me, friends, what is the comfort zone scores on a scale of 10 on this area. Assess yourself on the principles of derecognitions and the accounting treatments and tell me what is your comfort zones at this stage. So 10 out of 10, that's wonderful indeed. Now understood, it's 9. That's wonderful indeed. Super. So once you revise all this bit, sit down and go through the principles and all, you'll get everything clear. The journey started off with the chart which I showed you last time. And I think I'll just like to show you that, visit that chart once again, and you can see that all this is covered. This entire inputs which I'd given to you, if I just try to crop this and show you once, just for the sake. Let's put it like this. Now you can see the entire, this was the principles of accounting, which I've already covered with you. This is the principles of accounting. I consider the cash flow test expired, then it is transferred, then it is a case of those 3 conditions PTA. Then it was substantially transferred, risk and reward, substantially retained, and then it was control test. I converted this entire chart into a 3-step model to you. And then we did the 3 kinds of accounting as well. Okay, so one portion of derecognition is done. Now we go to the next portion, and that is supposed to be the derecognitions of financial liabilities. Don't worry, I'll leave some time towards the end for your questions as well. But let me, I think, first start with the inputs at this stage. 9.5, that's perfect. So let me, I think, first introduce you to the concept of derecognition of financial liabilities. Then I think last 10 minutes, we'll take your queries as well. So let's first go to the concept of financial liabilities in this case. Yes. Now this is the interesting part which explains the concept. Okay. Now let's have a look further out here. This is again going to be a slightly complicated part, but it's interesting. I'll give you a simple step-by-step approach in terms of how do you proceed with this agenda. Just like financial asset derecognition is about removal of financial asset from the books, same goes, the financial liability derecognition is a removal of financial liability from the books of accounts. Now, typically what we are discussing in terms of derecognition is the concept of what is called SDR. That is called strategic debt restructuring. So let me, I think, first explain and create some background. Let's say, for example, my company is taken a bank loan from a bank. So my company, let's say, is taken a bank loan from a bank. I am unable to pay the interest and or the principal, but I have full intentions to pay. I'm not a defaulter. So what I do, I go to the bank and start negotiating with them that, please relax the terms. So I go and request them to what is called debt restructuring. It happens practically very much. If you look at all the companies which go into insolvency, then what is the next stage is, maybe before the insolvency, they start negotiating the deals with the lenders. And they start saying that, okay, let's, sit down and let's restructure the debt. It's not that I don't intend to pay. But I request you that, you can maybe stagger the payments as of now. I'll give you the payments later, not at this stage. So that is called debt restructuring. It is called SDR. That is called strategic debt restructuring. Some entities approach the lenders to renegotiate the terms of the debt when they want to take advantage of the falling interest regime. Now, in accounting terms, there is a need, situations need to be evaluated whether the original debt is extinguished or not. Now, the standard says you need to apply what is called a 10% test. Now, don't get worried on what is this 10% test. It is something which I can say is more like a materiality test. So we need to apply a 10% test to consider that are we going to apply modification accounting or are we going to apply extinguishment accounting? Now, when I say it is extinguishment accounting, that means the old financial liability needs to be removed from the books of accounts. It's a case of a derecognition. But when it is a case of a modification accounting, that means the old financial liability is not to be removed. So there are two kinds of accounting. One is called extinguishment accounting and one is called a modification accounting. A modification accounting would mean that the old financial liability continues in the books of accounts. But in terms of the extinguishment accounting, it is eliminating the old financial liabilities and creating new financial liabilities in the books of accounts. Now, which kind of accounting would apply? It depends upon once we apply the materiality test, which is called a 10% test. Now, see what is to be done in this particular case. You can see there is a chart below which tells you that you need to see whether there is a substantial modification in the terms of the existing liability or not. So what do you need to do? You need to consider some mathematical calculations. So I'm giving you what kind of mathematical calculations are done. We'll see them with a practical illustration also later. I will take the present value of the cash flows under the new terms, add any kind of TC which has been paid. I will take the present value of all the cash flow. I renegotiated the terms with my bankers. So what I'm going to do, I will say, okay, let me calculate whatever is the modified cash flow, whatever is the new terms. Let me make a list of all the cash flows which I will pay as per the new terms, including any transaction cost, and calculate a present value. The question rises, present value will be taken at what rate? This will be using the original EIR itself. So I will just organize. So I'll divide this into a three-step model to make it easy. I'm going to convert this 10% test into a three-step model. So I will first of all calculate the present value of all the cash flows based on the new terms. And for this purpose, I will take the cash flows, including TC, discount them at the effective interest rate, original EIR itself. And then I will also consider the discounted present value of the remaining cash flows of the original liability. I will say, okay, let me also calculate that based on the old terms and condition, what is the present value of the original liability? So you are going to consider the present value here also using the original EIR itself. Now, please look at this on a mathematical angle. Now, look at this on a mathematical angle to appreciate the test in this case. So what we're going to do in step number 1, in step number 2, and in terms of step number 3, we're going to apply a three-step model. In step number 1, I will organize the cash flows and take a present value of these cash flows based on the original terms. Sitting on the day of renegotiation, I'll sit down with the bankers and say, okay, these are the remaining cash flows based on the original terms. Let me take a present value and indirectly get a fair value of this loan. Then I'll say, let me take the cash flows and take the present value. And this is again based on the new terms. So these are the cash flows which are based on the new terms. But when you take the discounting, the discounting in both the cases will be at the original EIR itself. So what do? I take the original cash flows, do the discounting. I take the new cash flows as per the new terms and do the discounting. Now tell me one thing, in both the cases, the discounting is at a common rate. So can I say the variations between step 1 and step 2 is only indicative of the pattern of cash flow? Is my thought correct? In step 1, you're taking the original cash flows at the original EIR. In step number 2, you're taking the new cash flows at the original EIR. Since the discounting rate is common, can I say the difference between the two is only attributed to the pattern of cash flows agreed because discounting rate is common? Making sense? I guess I'm making sense on that, and that's right. So which means once you use a common discounting rate, you are basically considering the difference is attributed only to the pattern of cash flow. So the standard set is decided, you take the percentage change. Take the difference between 2 and 1. Take the difference between 2 and 1 and express it as a percentage of 1 and see what is the percentage. Take the difference between the two steps, 1 and 2, the difference between 2 and 1 as a percentage of 1, you will get the variation which has occurred. And they say that if the variation is, and they say that in this case, the variation is if it is greater or equal, if it is greater than or equal to 10% of B. So we can say in this particular case, if it is supposed to be 10% or more, if it is supposed to be 10% or more, we will apply what is called extinguishment accounting. So if the 10% test tells you that the variation is 10% or more than 10%, then in this particular case, it is extinguishment. If it is supposed to be less than 10%, if the variation is 10%, it's called a modification accounting. In terms of modification accounting, the old financial liability will continue in the books of accounts. In case of extinguishment accounting, we'll remove the old financial liability. So derecognition will technically take place when you pass the 10% test. Because if the variation in terms of step 2 and 1 is 10% or more than 10%, it indicates a material change. And if it is a material change, then the old liability is extinguished, and otherwise it becomes a modification accounting. So the first thing what you need to do in the question is to identify a 10% test, leading to a conclusion that is it going to be a case of modification or extinguishment accounting. Once you have zeroed down based on these 3 steps, which kind of accounting will apply, then comes how does the modification accounting take place? How does the extinguishment accounting take place? And that's how the derecognition of financial liability gets taken care of. So you need to decide that first of all, applying a 10% test, which accounting would trigger. Then you need to learn the aspect of the modification and the extinguishment accounting. I hope, friends, you're able to connect the dots on that. Okay, now before I take further, I think some of you had some questions to ask. So I think let me just take some questions first at this stage. Then we can come back if time permits, though I don't think so. So now you can put your questions, what you had to ask. I think I put some questions pending at your mind. So please go ahead. You want to use a mic to ask your questions, you can, or you want to type it out, you can. So I think somebody wanted to put some questions, I guess. Please go ahead. Okay, I think Ayush, you put your question. This is the question which you put. Why not, in case of derecognition standard, choose fair value of guarantee as it's equivalent to 100% guarantee given to the factoring agency? No. You see, if you remember the example of a continuing involvement, you are giving a guarantee to the factoring agency to the extent of a limited amount. I think I'll just explain that bit to you. Just have a look at this. Just look at the 2 situations. Rather, let's look at 3 situations to get this very clear. Now, there is a company A Limited, and there is, let's say, a factoring agency, a factor. Now, let's consider the first case. A approaches the factoring agency, and he says that there is non-recourse. He says there is non-recourse. Is A liable to pay even a single penny? No. In this case, if A is not liable to pay a single penny, can I say in this case, a derecognition can easily occur? Because I have given the risk and reward to the factoring agency. My customer doesn't pay. I'm not responsible. I've worked out of my entire obligations. The second situation is A approaches a factoring agency, and in this case, it is a complete recourse. Now, if it is a complete recourse, let me ask you, is my liability limited? Is my liability equal to the entire book value of the asset? My liability is entire book value of the asset. So we can say that I am liable. My liability is towards 100% of the book value. If it is 100% towards the book value, then I think in this case, you cannot derecognize. You need to continue the asset in the books of accounts. Because in this case, you are completely still under a risk factor. And the third situation which we said is this one, where A goes to B and he says that I will give you a guarantee and I am going to give you a guarantee for a certain value. So your liability in this particular case, So here you can say the liability is 0. Look at the extreme. The liability is 0. Here the liability is 100%. And here the liability is limited to guarantee amount. It is limited to the financial guarantee amount. So therefore, a case of a partial derecognition is allowed in this case. You can see the liability factor is the answer. The liability on A is 0. The liability on A is full. The liability is restricted to a certain amount, which is the guarantee amount. Right, I think Ayush, you would have got your answer on that, I guess. Yes, I think yet to get some more questions. I think somebody said we want time for questions. Okay, I think I've got another question. So there is an illustration number 13, page 11.148, pertaining to prepayment option with the issuer, where there is a difference in contracted rate and the fair value due to which such prepayment option. How the difference in this, how we have done in prepayment question in the class where the difference in rate is due to conversion feature of the financial liability. Okay, I think I got the illustration if I'm not wrong. I understand. I think that maybe if you're talking of unit number 3, is it? Because in one of the illustrations where there is a prepayment option has been discussed later when it comes to the derivative accounting, and they've discussed the concept of embedded derivative. So I think giving an option of prepayment, because I think that lovely limited question which you're talking of, and then there is another question on the embedded derivative part. So in the embedded derivative part, if you say that the option is there with the holder in terms of deciding a prepayment, then it gives rise to an embedded derivative. So that is one area. But when we did the question of Lovely Limited, yes, you can say indirectly we did not acknowledge that fact that this option of prepayment is resulting in a derivative embedded in the instrument. We ignored it because I think even if you look at the solution in the study, it's not acknowledged that fact. And maybe I think for the reason, by the time that question was discussed, I think the prepayment option has got an embedded derivative has been discussed in a different unit altogether. But I don't deny, I agree with the point that if there is a prepayment option, it definitely leads to a derivative which is embedded in the loan instrument. I agree. So we have done prepayment question in the class with the difference is conversion feature of S. Can you take a mic to understand this better? If you could put your question through the mic, because I don't know if you're able to get your answer. Prepayment option with the issuer. Can you tell me the unit number? I can just open this and we could just interact. Krishnakant? It's in unit number 4. Okay, just give me a second. Let me just open the unit 4. Oh, that's on the embedded derivative, That's right. Okay. That's what I said. It's on embedded derivatives. 11.148. There's no page 11.148 in my study mat actually, which I'm carrying. Illustration number 13.
Students can give the hint of first line of the question so that it will be easy for sir to say. Maybe that page number is different. Are you referring the new study material, student or sir, which is uploaded on the website?
Yeah, ma'am. I think I've got the illustration 13, ma'am.
Okay.
Yeah, I think Krishnakant, I think you may be talking of this particular illustration 13. Yeah, you can ask me. You can use a mic also if you want to. I'll be able to understand better if you can use a mic. Is your mic working? I think, Krishnakant, can you use your mic? This, as I said, yes, it is a case where there is a prepayment option. Now, let me tell you, in this illustration, it is an assessment of the fact whether we need to segregate the derivative or not. So this illustration is not giving you the treatment post the things. The illustration is only making an assessment of the fact that whether a prepayment option, which is there in terms of a loan, would you segregate the derivative or not? So there are principles which are laid down, before this illustration, the prepayment options and debt instruments, and the application of that has been done, where the calculations have been done to give you an assessment that whether the things will be segregated or not. I didn't get any inputs from you. I think, Krishnakant, is your question answered or not? Okay, I think not able to get anything from your end. So can you pass the entry for the same? I have not covered this particular part so far. We'll be doing this in the next session. Maybe you've done it earlier, I think, because embedded derivatives, the discussion is still pending. So I think I've not discussed that. I think maybe you're asking me in advance on this. As I said, we've got the issues pertaining to the concept of embedded derivatives. So that we are yet to discuss. I have not discussed that part. By the way, let me first tell you that in unit number 4, what you're looking at the flow of the illustrations is the first thing is that though I've not told you that there is a host contract and then there is a derivative which is embedded in the contract. So we need to make some assessments to identify whether the embedded derivative will be segregated from the host contract or not. If you read that, then I'm just telling you in advance. So in this particular case, the question is only explaining you that whether the derivative, that is the prepayment option in the debt instruments, will that be segregated or not? So the question is doing the mathematical exercise of finding out whether the embedded derivative is to be segregated or not. It's not on the accounting of that. As you go to the further illustrations post 13, or maybe before that, you will see the illustrations are also given in terms of how the embedded derivative is segregated. Yes. So I think if you're looking at the entries of how the derivatives are segregated, I'll be doing 2 illustrations in the next class with you, where one would be in terms of, buying a machine, let's say in a foreign currency, and one would be a sale of machine, let's say in foreign currency. So that foreign currency would be, a kind of a derivative embedded in the purchase and sale contract. So how do you segregate that and what are the entries which are done as per Ind AS 109? That would be, of course, my agenda in the next session. So don't get worried on the accounting part of how the embedded derivative is done, because I'll do both the aspects, because there are 2 illustrations. One is on the sale and one is on the purchase. So there you will get the detail of the entries as well. Right. Any further questions, Krishnakant, on your side? Okay. Any further question, friends? Yes, another question comes in. Sir, also, if the holder has the option of conversion into variable number of shares, then from the holder's perspective, how will we account for the derivative financial asset? Okay. As I said earlier also, let me, I think, pinpoint that as well. First of all, let me tell you that derivative in this particular case, if you're looking at option is with who? Let's put it like this. If there is, let's say, an optionally convertible debentures, for example. Now, the possibility is that the option to convert is with the issuer or it is with the holder. It's with the holder or it is with the issuer. Now, you're looking at, if you look at the issuer, I think we already decided at that stage, I think from the holders, if I look at from the issuer perspective. From the issuer perspective, we discuss this situation And we said if it is a compound financial instruments, you'll segregate three elements: financial liability, which is non-derivative, financial liability, which is derivative, as well as equity. This we covered earlier when I covered the concept of optionally convertible debentures, that from the point of view of the issuer who calls it as a CFI, you will segregate the FL and the equity, and the derivative liability will be segregated. Now, if you say the option is with the issuer, I'm looking at this only. Books of the issuer, in this particular case, as I said earlier, you will say that it is going to be segregated in terms of FL, that is non-derivative. Then there will be a financial asset that is derivative, and there will be equity. This is from the issuer point of view. From the issuer point of view, if the option is with the holder, then what? If the option is the issuer. Now see the focus point clear. I know what your question is. This is a derivative financial liability if the option is with the holder. It's a derivative financial asset if the option is with the issuer. Now you're saying that let us consider that if it is a holder's perspective. If it is a holder's perspective, then there is an embedded derivative. I think again you went a little ahead of me. We are yet to discuss whether this embedded derivative will be segregated or not. That is the agenda. So if it is segregated, then I'll do it. If it is not segregated, derivative will not be segregated. So here the holder's perspective is to evaluate whether the derivative embedded in the instrument will be segregated or not. And that depends upon, to put it in advance, if it meets the equity characteristics, then it will not be segregated. And so this part, as far as the holder's part is concerned, this is discussed in the unit number 4. I think what we have covered earlier was in the issuer perspective in terms of unit 1 and unit 3. So this is the point, that whether embedded derivative in the financial asset is segregated or not. So for that, I think you'll have to wait for the next class. I think that's again a little advanced question. I've not covered that issue because we'll spend time in terms of understanding some basic principles where the embedded derivatives are segregated. The entire discussion is divided in terms of how to evaluate whether derivative will be segregated or not. That's one. And the second agenda is the accounting. Once you've decided that yes, the embedded derivative is segregated, how does the embedded derivative get segregated? I will be laying a little more emphasis on the accounting part, that once you've decided that the embedded derivative is to be segregated, how do you account for it? Because evaluating the parameters, whether the embedded derivative is segregated or not, fortunately, unfortunately, has never been touched in the exams, because that can involve certain subjective assessment as well. Though, of course, it is all explained, in detail in the study material regarding the parameters. So there again, it becomes two elements. Deciding the parameters is one stage, and then once you have decided to segregate, what is the accounting? I'm telling you in advance, we'll do the emphasis more on the accounting part, give you very basic inputs in terms of the parameters of evaluation. So I think if you're looking at this part, whether it will be segregated or not, that is in unit 4, and the accounting is also in terms of unit 4. But in terms of unit 4, there is no accounting which is done on a financial asset which is a compound financial instrument. How that segregation is done, that's not covered. You see, Ind AS 109, Ind AS 32 financial instrument is so huge that one can go beyond things as well. So we'll have to somewhere or the other limit ourselves to the examination perspective as well. I understand that your inquisitiveness is well appreciated, but then we can't go much beyond the examination levels as well. Trust me, financial instruments area is big. The number of pages in the standard on financial instruments, I guess, is running almost around 350 pages. 350 pages is the text of the standard in terms of 32 and 109 put together, not counting 107. And then you can imagine the kind of intensity the standard will go through. So we will not get into that part. But yes, specific this situation is not addressed in unit 4. But the basic fundamentals, the parameters will be discussed and the accountings will be discussed. Right. Yes, sir. I think that part is weak. I am trying a lot, but I don't know why it's not happening. Please help me only to cover this. Yes, in the next session, we'll be covering this part, the derivative part, because I'll be giving you exposures. You see, now if you come to impairment, technically, trust me, impairment we're going to cover from the examination point of view, but if you start looking at the nitty-gritties in terms of impairments in a practical life situations, it's huge. Because then there is a backward looking, there is a forward looking, there are micro factors, there are macro factors. Most of the things which are done practically on an ECL model and impairment is not even given in the standard. There are inside industry practices which are done. We can't afford to get into all that. You can understand, we in some way need to limit ourselves to the stage of examination as well. Right. I think that answers your query, right? Great. Right. I think no further queries seems to be coming in. So I guess over to ma'am.
Okay, thank you, sir. So,
Thank you, ma'am.
students, I understand that this topic is very technical, and some of them have already started the preparation, and maybe might be they have gone through the chapter one, earlier also. But definitely, I can assure you that going through these sessions of financial instrument, you'll have a big clarity. And what sir told is really true, that knowledge gaining is not going to increase marks. So from examination perspective, because this topic is very technical, but we have to restrict somewhere. But in case you want to gain more knowledge, you can do it after for examination. So you have, because it is not only financial reporting subject which you have to study, it is other subjects as well. So please, it is definitely required to have that conceptual understanding, but that research work is required in financial instrument, that we can go after, once you complete your revision and everything, and you are thorough with the topics, all the topics of financial reporting. Okay, all the best, students. Thank you, sir.
Thank you, ma'am. Thank you so much. Right, friends, time to say
Thank
you
you, sir.
goodbye.
Thank you, ma'am.
Thank you. Thank you.
Bye, ma'am. Bye, sir.
Bye.
Thank you. See you in the next class. Thank you. Bye-bye. Take care. Haji, thank you.